It's in the incentive of the US to maintain ambiguity, to play a multi-round game.
Everything here in the US, we have the strongest hand.
The United States is a big, important country. That gives us leverage in the world, but we are not infinitely big and not infinitely important.
We have been in the process of destroying the American brand, and this hope that country after country would come and beg for a deal is changing rapidly.
This kicks off a negotiation. This is not the end.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday with promises made, promises kept.
This is Liberation Day. I will sign a historic executive order instituting reciprocal tariffs. China, 67%. We're going to be charging a discounted reciprocal tariff of 34%. European Union, they're very tough. We're going to charge them 20%. Taiwan, we're going to charge them 32%. Japan, we're charging them 24%. We will impose a 25% tariff on all foreign-made automobiles. We will establish a minimum baseline tariff of 10%. Promises made, promises kept.
The president unleashing a major tariff push, 20% on the EU, 24% on Japan, 34% on China, and trade partners worldwide preparing to retaliate.
President Trump's announcement of universal tariffs on the whole world, including the European Union, is a major blow to the world economy. We're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
So for markets, it's Liberation Day for the Bears. Equity futures cratering overnight, well on course to snap a three-day winning streak as the uncertainty persists and the negotiations begin.
So today is a question of how much is it a game changer for the United States' position in the global world trade order. There has been a whole slew of different responses from Wall Street, one person after another. I was looking for one positive note out there. I couldn't find it. Neil Dutta of Renaissance Macro kicked it off with happy Obliteration Day, and that seems to be what a lot of people are asking. Why aren't stocks down more? And the answer is because there still is until April 9th to possibly negotiate.
Let's go through those dates, and you're right to point them out. So the higher tariffs start April 9th. The new baseline tariff of 10% starts April 5th. So there's space and time to negotiate here. But where it's a problem, it's unclear what the metrics are to get these tariffs removed. And hopefully later on this morning, we'll explore that with the Commerce Secretary, Howard Lutnick. Secretary Lutnick joining us at 8:30 Eastern Time. And that's got to be one of the number one questions for him. What are the metrics? Have you communicated them to trade partners?
This is the reason why a lot of people are talking about worst case scenario and other superlatives, not just because of the numbers, but because of the lack of detail, the lack of complexity, the sense that really it's trade balances and an overall look, a blanket look at all trade partners, regardless of the trade relationship the United States has with them. Where are the areas of negotiation? How do we get to an off-ramp at a time where Scott Bessent, Treasury Secretary, said to Annmarie last night, look, don't retaliate. If you don't retaliate, this is going to be the high mark, and we could possibly go down from there. When he was asked, are you open for negotiations? He said, not my bag. Check out President Trump.
Let's get to the price section. Equity futures cratering this morning worldwide, not just stateside, but underperformance is here in the United States. In the bond market, 2-year, 10-year, 30-year, down by 8 or 9 basis points. But it's in foreign exchange where I think we really have to look. Coming into 2025, we thought higher tariffs meant a stronger dollar. This morning, higher tariffs, a much, much weaker dollar. Euro dollar, 110. Dollar yen, a move of 1.9%. Sterling not alone. Strength for sterling, weakness for dollar, 131.70.
To me, this is the most important move right now in markets. George Saravelos of Deutsche Bank came out this morning and said, we have been warning about the importance of the correlation breakdown between U.S. risk assets and the dollar for a while. We are now looking at underperformance for U.S. assets by European investors that rival anything we've seen in the past number of years. A real question about whether this truly is a test of U.S. exceptionalism.
We've got a lot to get through. Coming up on this program, Dan Greenhaus of Solus Alternative Asset Management as global stocks sink. Terry Haines of Pangaea Policy on the steepest American tariffs in a century. And Bob Michael of JPMorgan Asset Management on the probability of recession. We begin this hour with our top story. President Donald Trump slapping a minimum 10% tariff on all U.S. trading partners and even higher duties on 60 nations. Annmarie joins us now in Washington, D.C. Annmarie, the negotiations begin.
the negotiations begin. You brought up a great point, Jonathan, talking about the fact that when it comes to the 10% baseline universal around the world tariff that is levied on all of these countries, that will kick in April 5th. And then if you're a country that is on this list, this chart the president brought out yesterday, those tariffs, the European Union, 20%, Vietnam, 46%, China, 34%, and cumulative when it comes to China, we're looking at a tariff more than 50%. That'll kick in April 9th. The key question I have today is that timing, that gap we have, the 5th, the 9th, is that to just get customs and the border prepared to change the computers to make sure they are bringing in these tariff dollars? Or is that the start of negotiations? Scott Bessent, the Treasury Secretary, told me yesterday a number of countries have already called. It is up to the president now how he wants to negotiate.
Annmarie, do you have a sense of who around him has the biggest heft when it comes to influencing these decisions?
Well, I would say this is a team decision. You had a number of voices in the room, Scott Bessent being one of them. But one thing was very clear after my interview, something I took away after I spoke to the Treasury Secretary after that Rose Garden event, is that this is not exactly something he is going to be intricately involved in when it comes to negotiations. This is going to be run out of the Commerce Department with Howard Lutnick, who we'll be speaking to later today, the Trade Ambassador out of USTR, Jamison Greer, and of course, the most hawkish individual around the president that I felt like really had a leading role into what we are seeing today is Peter Navarro.
Annmarie with the latest. Much more from Annmarie. Down in the nation's capital through the next 3 hours of programming or so. Equities are down by more than 3 percentage points on the S&P 500. AMH catching up with Secretary Bessent just yesterday following the decision. Asked about the equity market sell-off. He pointed to the Nasdaq, pointed to when it peaked, DeepSeek, and said this looks like a Mag 7 problem, not a MAGA problem.
It felt rehearsed, and they clearly are going to address the drop that we're seeing in stocks. This drop is much broader based than simply big tech. This is the ultimate question. Is there a Trump put or isn't there? And have we reached, at least approached, some of that call level?
Let's get you a take from Dan Greenhaus of Solus Alternative Asset Management, who writes the following. This isn't great, and it's more onerous than thought, meaning more upside to inflation, more downside to growth. Assuming countries don't retaliate, this is as bad as it gets. Dan joins us now for more. Dan, good morning.
Thank you for having me, sir.
Is this the clearing event people were looking for?
This is the conversation everybody keeps having. I don't think so. I haven't thought so, and I don't think now. I do want to echo Anne-Marie's point. We've moved from one uncertainty to another. We didn't know what would be implemented, when it would be implemented, how large it would be, et cetera. We've dispensed with that uncertainty, and now we're in, to Anne-Marie's point, is this a negotiating window? I think it is, but perhaps it's just simply a mechanical window to allow the border and customs agents to get their ducks in a row, so to speak. So now we have an idea for what's going to be implemented, but who's going to come to the table? We've already seen Israel say, we're taking off all of our tariffs on the United States. Obviously, that's not a particularly large trading partner for the U.S., but it is indicative of the type of response that you'd like to get from other countries if you're Donald Trump and the administration.
We are learning something about how the market's responding to this. U.S. equity underperformance has dominated 2025. Continues this morning. When we came into the new year, we thought the dollar would strengthen off the back of announcements like these. It's weakening. What's the signal that you take from that?
Well, I mean, listen, I'm looking at the dollar right now. Depending on whether you use the DXY or the trade-weighted index, it's still higher than it was prior to the post-COVID rally. It's still obviously much higher than it was pre the taper tantrum in the middle of the 2010s. Kids, Google it if you don't know. So there, in that sense, we do have a relatively speaking strong dollar. But I mean, the answer to this question is the same answer to a number of questions, which is I don't know. Because there is a worst case, to Lisa's point earlier about looking for positive takes around the street, everyone's going to assume the worst case outcome right now because that's all we really have. However, if in 2 days, to Scott Bessent's point about countries calling and willing to make some agreement, if you start getting some headlines that, okay, well, Germany or China or Mexico or whomever has decided to come to the table and meet some of the president's demands, then some of these worst case outcomes are going to come off the table very, very quickly. I think they already should, but even more so.
Do you think the worst case scenario is actually being priced in right now?
Well, no. The worst case scenario is a recession. And if I tend to look at this purely through the prism of the stock market, and the stock market's off, call it 8% from a high. add in 3% now, you'll be down 10, 11% or so. A recession's a 20% drop in the stock market, at least, if not a third. So you're probably calling it pricing in half of a recession right now through this simplistic framework. So there is more downside if things get worse. And to a point a number of people have made, this isn't really going to start hurting until the middle of the year. And so there is plenty of time to deal with those worst case outcomes. But at the same time, there's plenty of time for them to come to fruition. At
the same time, person after person who's come on this show has said that the uncertainty alone has been such a drag on growth, has been such a drag on confidence among consumers as well as corporations. And the longer this goes on, the more the damage will become entrenched before you get the inflationary one-time pop, or maybe longer, from tariffs. At what point can we say uncertainty is policy?
Well, listen, you've seen, obviously, consumer confidence crater, CEO confidence has come down, investor confidence is not good at all. The AAI bear survey is basically at its highest level. However, when you listen to a number of earnings from retailers, I think they've been, on balance, to my ear, pretty good. Obviously, that's not to say there aren't companies that have specific issues. Lulu is dealing with some specific issues there. But then you have Dick's Sporting Goods and Walmart put up pretty good comps, mid-single digits. There has not yet been a meaningful impact to larger consumer behavior, at least as far as I've seen. Obviously, you had the weather issue in the first quarter, particularly in January. But when I listen to the companies that reported most recently, on balance, it seems still pretty positive to me. So, plus you've had egg prices come down, and don't discount the importance of that. But
crisis over.
That's right. Crisis over for eggs, at least. But from one into the frying pan into what is it? But
is that the most optimistic point that you can come up with? Is that eggs and prices going down?
For the viewers, I was telling Lisa before I came on.
Scrambling.
I'm sure the next 3 hours is going to.
I went there. I want to get to the data. Let me jump in.
Please.
ISM services later this morning. We get payrolls tomorrow. Get jobless claims too in between. How useful is that economic data?
I mean, it's very useful, but the idea that tariffs are somehow going to influence jobless claims this week is obviously not a thing.
So we'll ignore strength. That's kind of what I'm getting at with the data over the next few days. Are we just going to ignore strength, but if it's weak, it's got to be really weak?
Well, I don't think you should ignore strength, but I think clearly the issue in the market right now is about what happens over the next 3 months, 6 months, 9 months. And I think there's an issue around the middle of the year when if prices start going up, if you start getting some additional job losses, real personal income growth might be slowing down, in which case consumer spending is going to slow down. And then you're going to start hearing people talk about more recessionary conditions, legitimately recessionary conditions around the middle of the year. I'm not sure that's exactly what comes to pass because, again, I continuously come on here and try to make the optimistic take on things, if only because everyone else is going to come on and do the exact opposite. But no, I don't think you should ignore strength because I also think the economy is doing okay. I know the first quarter is not going to be a great number, but there were some one-offs that affected that. But this idea that you should bet against the U.S. consumer has been wrong time and time again. And I'm not saying that I should ignore what's happening, but I also think we underestimate the U.S. economy's strength.
And we have done over the last 5 years, repeatedly, and you're right to point it out. I'm hearing this from economists this morning, I'm sure you're hearing the same, that these tariffs, if they stick, regardless of whether people retaliate, could lead to an additional 1 percentage point to core inflation this year.
Yeah.
Chairman Powell speaks on Friday. How does he step in on potential weakness with core PCE pushing 4% by year end?
This is the big debate in the economics community. If a lot of this comes to pass, how does the Fed respond? I think I'm in the camp that thinks they probably respond more to the weakness. I mean, he used the word transitory to describe tariffs in the press conference the other day. I think, gun to the head, I think that they're likely to say, okay, these price increases are going to be temporary, and I care more about the economic and labor market weakness that would commensurately be unfolding. And so in that scenario, you'd be talking about 2 to 3, 3 to 4 rate cuts as opposed to 1 to 2, let's say. So I think that's where I come down on that topic.
Not everybody watching has a time horizon of 5 minutes. A lot more people are watching programs like this morning, trying to work out what's going on with financial markets and what's happening with their retirement accounts. Is this an opportunity for them to buy? When you look out 12 months, 24 months, 36 months, will you look back at this moment and say, that was a good entry point?
Almost always the answer is yes. There's a book out there called Just Keep Buying. And I on balance, if you're talking about your retirement account and and this is, listen, we're a hedge fund, we're not a financial advisor, but we're an IRA. But listen, on balance, the market goes up. And I think to the extent that one believes, as I do, that some of these worst case outcomes are not going to come to pass because there's a negotiation that's going to take place over the next couple of hours, days, and weeks. in which case down 10, 15% for the S&P 500, then on balance, you do want to buy that. But there's a separate issue here. I know the conversation today is going to be all tariffs, but there's another headline about Microsoft pulling back from some AI data centers. And heretofore, there have been very few headlines that have contradicted the AI narrative, the CapEx investment, the demand, the growth, et cetera, et cetera. You're starting to see cracks in that window. And those are the types of things you want to pay attention to, because there's been two driving factors for U.S. equity markets over the last couple of years. It's been U.S. growth exceptionalism relative to the rest of the world, and it's been the AI story, both of which have boosted risk assets in the United States commensurately, when compared to around the world. Both of those issues are being challenged right now. The U.S. growth exceptionalism, obviously, and increasingly the AI data story. And so it is down 10 to 15% when you're supposed to buy. Almost invariably, the answer is yes, unless you're going into a recession. But with both of these stories being challenged right now, it might not be so simple.
It's the Max 7 problem the Treasury Secretary was talking about with Annmarie yesterday afternoon.
Which has been a huge component of it, and there's one reason why it's not just the tariffs. That said, if you're talking about a sea change in trade, and suddenly recession calls screaming across the street, that's the reason why you have a lot of negativity right now.
Fair to say this morning this is an everything problem.
Yes.
Equity futures at the moment down by 3.4%. Dan, it's good to see you.
Thank you, guys.
Thanks for dropping by. Dan Greenhaus there of Solus Alternative Asset Management with an update on stories elsewhere this morning. If there are any stories elsewhere this morning, with your Bloomberg brief, here's Yahara Hackett. Hey, Yahara.
Hi, John. We start with the big story. President Trump is raising tariffs on countries around the world. He announced at least a 10% tariff on all exporters to the U.S., with about 60 nations seeing even higher duties. Bloomberg Economics estimates the effective tax rate on more than $3 trillion in imported goods could rise to about 23%, the highest in more than a century. In Washington Senate, Republicans unveiled a budget blueprint that would fast-track a renewal of President Donald Trump's tax cuts with an additional $1.5 trillion in tax reductions, and it would increase the debt ceiling by up to $5 trillion. The Senate plans to vote on the budget outline in the coming days. And Dan mentioned this story. Microsoft is pulling back on data center projects around the world as uncertainty grows over investments into AI and cloud computing. According to people familiar, the company has recently halted talks for sites in Indonesia, the UK, Australia, Illinois, North Dakota, and Wisconsin. It comes as analysts have ramped up their scrutiny of heavy data center spending by Microsoft and other hyperscalers. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the programme, promises made, promises kept.
I campaigned on this policy throughout last year, and today that promise was made, and it was also a promise, as you know, that was kept. Promises made, promises kept. This is not full reciprocal. This is kind reciprocal.
Terry Haines of Pangaea Policy joins us next, and later we'll catch up with Jim Zelter of Apollo, the former Trump White House trade official Katie Kalutkiewicz, and Commerce Secretary Howard Lutnick. Live from New York City this morning. Good morning. Neil Dutta, Renmac. Perhaps investors assume cooler heads will prevail. I wouldn't hold your breath. Equity futures down 3.4% on the S&P. The Nasdaq down by close to 4%. In the bond market, a rally. Yields on a 2-year, 10-year, 30-year down across the board. But check out foreign exchange. The euro, looking at the biggest one-day move going back to December 2015. Euro dollar 111.18. Under surveillance this morning. Promises made, promises kept.
We will establish a minimum baseline tariff of 10%. That'll be on other countries to help rebuild our economy and to prevent cheating. I campaigned on this policy throughout last year, and today that promise was made, and it was also a promise, as you know, that was kept. Promises made, promises kept. This is not full reciprocal. This is kind reciprocal. If they complain, if you want your tariff rate to be zero, then you build your product right here in America.
So here's the latest this morning. The president slapping a 10% tariff on all exporters to the United States and higher duties on dozens of nations, including the EU, China and Japan. Annmarie joins us now from Washington for more. Annmarie, massive moves.
Massive moves when it comes to what's going on in the fallout in the equity market, Jonathan, following the massive Terrier walls that the president put up last night. He's calling it Liberation Day, promises made, promises kept. The key question now is, will there be negotiations? And for that conversation, I'm pleased to be joined by a friend of the show, Terry Haines of Pangaea Policy. Terry, you put out a note last night. You said Liberation Day tariffs now watch for many, quote, path-dependent negotiations. Do you think all of these rates that the president outlined yesterday can come down?
I think a lot of them can, sure. The one reason I would say that is that Secretary of Commerce Lutnick has been kind of preloading everything over the past days and weeks with a lot of different countries, saying, here's what we'd like on tariffs, here's what we'd like on tariff barriers, here's the realm of things we want to talk about. Those other countries have already been discussing that internally, and they'll have internal politics as well as external politics, things they can do, things they can't.
Commerce Secretary Harold Lutnick has been in touch with his counterparts. A few times he's been on our program even saying he was going to talk to, say, his European counterpart that day when Trump came out with a 200% tariff on wine, champagne, and cheese. Why not then just do the deal? Why have this destructive, what some would call in the market, moment right now to get to that point?
I think the administration wagers that trade negotiations of those kind never end. And they'd get bogged down in not being able to finish them. I think they think that there's more value in kind of a shock and awe approach that brings people to the table and incents them to do things and actually get something done.
April 5th is when the 10% baseline goes into effect, and then April 9th for if you're one of those countries that has a higher level like the European Union at 20%.
Right.
Do you think we get a deal before April 9th?
I doubt that. Some places will probably have that happen, yeah, but I think the big places won't. There's too much complexity internally in a very large country to be able to check off with stakeholders, figure out how you want to change things, go through the legislative or regulatory process. I think that's all very unlikely.
Trump's entire economic agenda is a three-legged stool: deregulation, tariffs, and tax cuts. If one of these stools collapses, the entire agenda might collapse. How quickly do they need to get the tax cuts to make sure they keep this economy afloat?
I have it at 80% by the end of this calendar year because of that's the way the congressional process will work. Third quarter is largely screwed up because of the need to deal with spending bills. But at the same time, can they do it faster? Sure. And that's exactly what Besant told you yesterday, is that...
It's why they're including the debt ceiling into this reconciliation
Well, exactly.
package.
But he's going to now he's now going to turn his attention to dealing with the tax cuts. I joked on your radio side this morning that Besant's going to be the Gary Cohn of 2025. And that's largely the way I think markets should look at it. But Lutnick's going to be the guy who deals with the tariff issue.
Okay, but when it comes to those tax cuts and how quickly they need to get it done, we're just talking about an extension of current policy. The sweeteners, no tax on tips, no tax on Social Security. Does that actually get done? The Treasury Secretary seems to think so. I'm not so sure when I speak to sources on Congress.
Do I think it gets done? Yeah, I do. Certainly by the end of the year.
The extras?
Yeah, I think so.
You think all of them, this economy, the budget hawks, the deficit hawks, are willing to sign up for that?
They eventually will be, yeah, because one of the many reasons why there's Trump urgency is because Trump understands that his biggest leverage points politically with members, particularly deficit hawks, come up in the midterms.
All right.
And I think that's where you'll see a lot of that.
Terry, thank you so much for your time this morning. Jonathan, of course, Terry Haines of Pangaea Policy, a friend of the show. He thinks it's a shock and awe moment to get negotiators to the table, but doesn't sound like we'll get deals before April 9th.
A lot of people hope he's right, that's for sure. Annmarie, appreciate it, thank you. The number one strategic anchor for the equity market bulls, the belief that when you take a step back, take a big picture view of the complete policy platform from this administration, it is still pro-risk, pro-growth. Are they rethinking that this morning after yesterday's announcement? Up next, Bob Michael of JPMorgan Asset Management on the probability of a recession. From New York, this is Bloomberg. One line from Eric Robertson over at Stand Chart. Stagflation looms large. Andrew Honhorst of Citi suggesting if these tariffs stick, we're talking about an additional 1 percentage point on top of core PCE by year end. So that takes us to about 4%. If you get to about 4% year end and this economy weakens, can this Fed respond? That's a conversation we'll have in a moment. Equity futures are down by more than 3% on the S&P. On the Nasdaq, we're lower by 3.9. In the bond market, yields are down and down hard, down 9 basis points to the front end of the curve. On 10s, we're down 8. New lows for 2025, just north of 4% on a 10-year maturity. And in foreign exchange, some of the biggest moves we've seen in the FX market in the best part of a decade. Euro dollar, a 2 percentage point move. Euro dollar this morning, 110.86. With 3 hours until the cash open, let's get you some morning movers. Here's Yahara Hacker. Say Yahara.
Hi, John. We start with big tech taking a major hit here. Some of that having to do with the Microsoft data center story, but it's these tariffs that are really stinging. And Apple definitely has it the worst. And that's because Trump's tariffs on China and elsewhere are much higher than anticipated. So even though the iPhone maker has begun diversifying away from China, the tariffs are poised to hit it in the exact places it shifted toward, like Vietnam and India. Next up, we have the chip stocks also getting pummeled here, and that's because the tariff on Taiwan is much, much higher than anticipated at 32%. A big problem since all these three companies, NVIDIA, AMD, and Broadcom, rely on Taiwan's TSMC to produce some of those most sophisticated chips. And last up, we have the shoemakers and apparel stocks. They are getting hit as well, and that's because of the massive 46% tariff on Vietnam, where a lot of them had diverted production to in order to avoid U.S.-China trade tensions. But now there is nowhere to hide, John.
Yahara, thank you. Appreciate the update. I'm pleased you finished on that story. Lisa, think about it. Trump, volume what? Goes after China. You move all your supply chains away. You try and insulate yourself. You think, I'm going to Vietnam. Go to Vietnam. You move everything there. And then all of a sudden yesterday, 46% tariff on Vietnam.
This is actually exactly the point, that President Trump is going after the connector countries that have picked up the slack and hidden some of the Chinese exports that have been heading to the United States. Key question for me is this is choosing Taiwan, Vietnam, Malaysia, the Philippines to choose between China and the United States as trading partners. And it puts them in a really precarious situation given both the U.S.'s track record and their geographic proximity to China.
That has major foreign policy implications as well, which is what you're alluding to. On our radar this morning, President Donald Trump slapping a minimum 10% tariff on all U.S. trading partners and higher duties on 60 nations, including 20% on the EU, 34% on Japan, 34% on China, 24% on Japan, rather. And the targeted tariffs, they'll kick in on April 9th. How will people respond? China and Europe vowing to retaliate against Trump's tariffs. China's Ministry of Commerce urging the U.S. to, quote, immediately cancel the tariffs. European Commission President Ursula von der Leyen saying the EU is preparing countermeasures if, and I think this is a really important if, Lisa, if negotiations fail.
And this really opens up the question that a lot of people are grappling with this morning, which is how much room is there for negotiation before April 9th? Do we get some sense that this gets walked back in a massive way? One aspect of the response that's very important is fiscal stimulus. And it's not just coming from Europe, but also from China. If there are major fiscal injections in those regions, that just amplifies this idea of exceptionalism, leaving the United States with fiscal retrenchment and heading overseas.
Some confusion yesterday regarding China. It was a question I had when this was all unveiled. Is this inclusive of or in addition to the tariffs that have been announced in the last few weeks? And we found out it's in addition to. So the number you saw there for China, that's the reciprocal push. Put that on top of the fentanyl push, and you end up with a number of 54% in total. Brutal.
Yeah, or possibly 67%. Bloomberg Economics looking at some of the ideas of what else has been implemented on aluminum and everything else. That is how much they estimate the tariff rate on Chinese goods will go up. Again, how plausible is this? And then you throw in some of the other potential areas, whether it's fentanyl, whether it's TikTok, et cetera. Where are the off-ramps here?
You mentioned fiscal policy, so this is the next big push down in Washington, D.C. The Senate unveiling plans to fast-track tax cuts and a debt limit hike. The plan allowing for a $4 trillion extension of Trump's tax cuts and additional reductions of $1.5 trillion. This coming ahead of a planned vote on the resolution later on this week. Annmarie catching up with Secretary Bessent just yesterday. He was really trying to push that story forward at a time when this equity market is cratering for different reasons.
And this is the ultimate sweetener that people have been looking for, the second half story. Neil Dutta, I want to go back to what he said of Renaissance Macro initially. There is no offset from the tax law. That is, at best, an extension of what we already have in place. The tariff stuff is what is new, and we are talking about from Trump. You can't root out retaliation later. People are not looking at this as an incredible fiscal expansion. They're looking at this as simply extending the tax cuts that would have been put in place.
On the retaliation, the EU vowing to retaliate after President Trump's 20% tariffs on imports. The European Commission President Ursula von der Leyen saying, quote, "We're preparing for further countermeasures to protect our interests." Bloomberg's Ollie Crook joins us now for more from the NATO headquarters in Brussels. Ollie, we'll get to why you're there in just a second. Just outline for us, please, for people waking up in the United States, how has Europe responded to this push?
Yeah, Jonathan, a couple of points here. I would say that 20% rate that the United States has imposed on the European Union, first of all, is on the higher end of what European officials were expecting. They're expecting something between 10 and 25%. They got 20%. That is a huge number, that goes without saying. And for the Europeans now, it is a question of sort of appraising how they're going to respond. We heard it there from Ursula von der Leyen saying that they will have countermeasures. They're going to draw them up if, and that's the key if, John, if negotiations fail to be able to get the barrier a little bit lower in terms of negotiating this tariff down. But the other question, I think, for most of the European policymakers here, and some of them that I've spoken to this morning, is how do you even go about negotiating this, right? When we think about the difference in tariff rates before yesterday between the EU and the United States, it was about 1/2 of a percentage point. Now you've got 20%, and you're trying to bring that down by offering what? Offering potentially non-tariff trade barriers. This is what Trump was talking about yesterday. He made reference to sort of EU poultry and chicken, saying that you basically can't get it into the market from the United States because of these non-tariff barriers. How do you negotiate that? How do you sort of present those things? What is a 1% tariff equal to in other sorts of domains like VAT and those sorts of things? That is going to be the big sort of question for European officials here, who really do not want to respond, who do not want to engage into a trade war, but they need to come up with something and present it to the Trump administration.
Oliver, how much clout do they have politically to really negotiate, given the anger in Europe toward the United States, in the sense of are we really going to cave?
I think it's going to be very difficult, but at the end of the day, I think that for the Europeans, the reality of the situation, and this is how we know the United States arrived at their tariff level, there is a big imbalance in terms of trade. There's a $1 trillion relationship, so for both parties, this is immensely valuable, but there's a trade deficit of about $250 billion in the sort of in the favor of the Europeans. So at the end of the day, this is always going to hurt the Europeans more going forward, and we're seeing today already the impact on the private sector. Those auto tariffs, they are live. We have Volkswagen talking to dealerships in the United States, talking about they're having to raise price and add fees. It's already happening.
Ollie, just to finish up, you are at NATO. The Secretary of State, Mr. Rubio's over there right now. What's he saying to the Europeans?
So really interestingly, John, this morning we heard from Marco Rubio, and I think the messaging from Rubio in terms of the commitment to NATO, that it is still strong, is exactly what the Europeans wanted to hear. And frankly, John, I don't think that they were sort of necessarily expecting to hear, basically saying that the Trump administration is fully committed to NATO. That being said, they are committed to a NATO that takes their own defense more seriously, that is more robust. They reiterated that 5% figure. Trump is not letting that go. He would like to see 5% GDP spend on defense. But the other thing that was really important that we heard from Rubio today is that the U.S. itself seems to be also committing in the long term to hit 5% of its own GDP spend on defense. It's at about 3.8%, and that's the first time we've heard that so explicitly from the U.S. administration.
Ollie Crook with the latest. Ollie, appreciate it. The latest from Europe. Bloomberg's Oliver Crook. Bob Michele at JPMorgan weighing in on the impact on the tariffs on the economy. We will watch closely the reaction of corporate America. If they respond aggressively to narrowing margins and reduce top-line growth by scaling back their workforce, then the probability of recession goes up sharply. Bob joins us now for more. Bob, good morning.
Good morning.
That interaction between the tariffs, margins and consumer price tolerance is going to be really, really important over the next few months. How do you think it breaks?
Well, I've been spending the last 12 hours reading all the output of our economics team, Bruce Kasman, Mike Feroli's team, and Michael Semblist, and they all wind up in the same place, which is, as things stand now, we're headed to recession. And it's very clear that this is a tax on businesses and households. Yes, Besson can talk about offsetting it with an extension of the Tax Cut and Jobs Act, but right now a heavy tax has been applied to businesses and to households. Businesses have to decide how much they're going to absorb and how much they're going to pass through. The one thing they can plan on is that top line will come down. They're going to see a reduction of sales, their input costs will go up, and they're going to look at narrowing margins. And if their sales drop enough, they are going to have to lay people off. And of course, that will hit consumer confidence. So this is not good at all.
At the same time, Citigroup came out, as John mentioned earlier, and said if sustained, these tariffs could add an additional 1 percentage point to core inflation this year, bringing core inflation to 4%. There seems to be this feeling, with hard data not rolling over as quickly as the soft data, that the Fed is destined to be late and not cut rates in response to that expected recession. Do you agree?
I hate that line of thinking, and I'll tell you why. I feel like we're supposed to go back and dust off our Econ 101 books. And very clearly in there, it talks about the difference between demand pull, which is what we saw during COVID inflation, and cost push. And cost push inflation cripples businesses and households and ultimately pushes you into recession if it's bad enough. The Fed already told us a couple weeks ago that, yes, it's not pleasant to have this cost push inflation, but they'll look through that. They're more concerned about the downside. They're more concerned about the impact to employment. So I think where's Binky when you need him? Year end is so far away. April 9th is so far away.
You enjoyed that yesterday.
I love that. April 9th is so far away. A lot can happen. But if these policies stick for the next quarter or so, then you have to start pricing in the Fed brings down rates to 2.25, 2.5.
You might hate this line of reasoning, but a lot of people are entertaining it on Wall Street. And Morgan Stanley overnight actually took away their call for a June rate cut and looked at potentially no rate cuts for the remainder of this year, because this is a Fed that is coming off a highly inflationary moment. Mohamed El-Erian yesterday saying the same thing, that this is a different kind of moment given what we have just seen post-pandemic. At what point does the Fed not offset growth concerns, but juice inflation concerns on the other side?
This is a very different moment than what we went through during COVID. As I said, this is a tax that's applied to the system. Sure, if you're the Fed, you're not going to ignore that inflation is now cruising up above 3% to 4%. What you're going to look at is it temporary? I can't use transitory. Is it temporary, or is this the kind of thing that's going to lead to a wage price spiral? And for now, it doesn't feel like it will. It feels like you'll see a dramatic decline in consumption, and they will respond. And by the way, you go back to when the regional banking system was crashing, the Fed had every opportunity there to let the system wash out. Did they? No, they stepped in. So, yeah, it looks like we're cruising to recession now unless things change. But both COVID and the regional banking crisis tell us you've got to watch the policy response. And the Fed and other central banks have a lot of dry powder.
They stepped in with support, as you know. They also hiked interest rates.
Yes, they did. But they created an enormous safety net around the entire system. My point is that, yes, you can model everything for recession. We don't know if there are going to be any negotiations over the next week.
True.
And if there aren't, then the Fed can bring rates down a lot.
Let's say they go to 2.5. Treasuries right now on 10s, just north of 4%. What kind of numbers have you got in mind across the curve?
If they're headed to 2.5, the market is going to front run that. You'll get down to 2%. On
10s or at the front end?
The whole thing.
The whole curve's coming down to 2.
Look, they only got to 4 3/8, and the whole curve went down to the low 3s, right? So the market will start pricing in that they'll go a lot lower. I'm not calling for that. I think there's a lot of room for negotiation. I think we'll see, some of these backed off. I don't think the administration wants to crash the economy. All I'm saying is, let's not forget, there are many potential policy responses. an extension of the Tax Cut and Jobs Act and hanging a lot more off of it is one, but central bank policy is another.
Bob, we've got some time with you, I'm happy to say. Bob Michele at JPMorgan Asset Management will be sticking with us. We've got some time to negotiate as well. The baseline tariffs start on April 5th. The higher tariffs start on April 9th. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. Mark Zuckerberg is lobbying President Trump and the White House for a settlement that would prevent Meta platforms from facing an antitrust trial later this month. That's according to the Wall Street Journal. The Federal Trade Commission trial set for April 14th could force Meta to unwind its WhatsApp and Instagram acquisitions. Meanwhile, Amazon is making an 11th hour offer for TikTok. Sources telling us the company submitted a bid to the White House to buy TikTok's U.S. operations from its Chinese owner, ByteDance. President Trump was expected to meet with top aides yesterday to consider proposals ahead of Saturday's deadline for the company to find a buyer or face a U.S. ban. And President Trump said the other day he'd consider running for a third term in office, but The Hill is reporting that J.D. Vance and Kamala Harris are seen as top presidential contenders by their respective parties in the 2028 presidential election. Almost 70% of Republican respondents would consider voting for Vance, while almost 60% of Democrats would consider Harris. That's your Bloomberg Brief. John?
Yahara, thank you. Lots more coverage of this market move still to come. Up next, auto tariffs take effect.
Toyota sells 1 million foreign-made automobiles into the United States, and General Motors sells almost none. We will impose a 25% tariff on all foreign-made automobiles.
Up next on the program, Craig Trudell of Bloomberg and more from Bob Michele of JPMorgan Asset Management, live from New York. You're watching Bloomberg TV. A 10% tariff across the board, 20% on the EU, 24% on Japan, 34% plus on China, and equities sinking. We're down by 3.5% on the S&P. On the Nasdaq, we're down by close to 4. On a Russell, down by 4.7. Under surveillance this morning, auto tariffs take effect.
Toyota sells 1 million foreign-made automobiles into the United States, and General Motors sells almost none. Blame former presidents and past leaders who weren't doing their job. They let it happen, and they let it happen to an extent that nobody can even believe. That's why, effective at midnight, we will impose a 25% tariff on all foreign-made automobiles.
So here's the latest this morning. President Donald Trump's 25% tariff on U.S. auto imports taking effect shortly after midnight, as promised. Bloomberg's Craig Trudell joins us now for more. Craig, welcome to the program. What changed for these manufacturers at midnight last night?
I think this is going to be hugely disruptive for this industry. And just to correct what the president just said, if you're defining imports of vehicles from foreign nations, as he put it, as including Mexico and Canada, GM is importing a lot more than almost none from the U.S.'s neighbors. This is going to affect GM. It's going to affect Ford. And also, Jeep and Ram and Chrysler maker Stellantis. So this will have an impact even on Tesla, which, I think everybody sort of views as a potential, winner, at least in terms of getting hit the least. But even Elon Musk has talked about the idea that, tariffs on imported parts will also hit his company, even if he's somewhat insulated by the fact that he makes his electric vehicles in the U.S. for the U.S.
Craig, just quickly, is there space to negotiate here at all?
I think, this is going to be difficult for other countries to move Trump off of his view, because we know that this is something that, he's had in his craw for decades, that, he talks about the Mercedes that he sees on Fifth Avenue and the lack of Cadillacs that you see, in Germany or elsewhere. So, this is something that clearly is a firmly held view of his, and it's sort of, front and center when he talks about trade and how the rest of the world in his mind is, and to quote him roughly, is ripping off the U.S.
Craig, appreciate the update. Craig Trudeau there out of London this morning. Bob Michele at JPMorgan Asset Management still with us. Bob, let's get to corporate credit. As you look across things right now, is there anything you've been pulling away from and why?
Yeah, we had our investment quarterly 2 weeks ago after the last FOMC meeting, and we were surprised at the complacency across markets, but more especially in corporate America. And when our analysts were talking to companies, they were mostly coming back with, well, we have to wait and see what the shape of tariffs looks like. Well, it can probably absorb some, pass some through. What we didn't hear was, we're planning for this. If it's 10%, we're doing this and not that. If it's 20%, then we have to go to plan B and so on. So we came back and reduced our exposure pretty dramatically and added Treasury exposure.
Is it just U.S. corporates, or is this a global phenomenon at a time when places like Europe and China are planning fiscal responses?
It has to be across the board. You have to pull back and see where things settle out. And we're talking about room for negotiation. The more positive side that could happen over the next week, I think we also have to be aware you could see sectoral tariffs. We could see over the next few days tariffs put on things like pharmaceuticals, like semiconductors. We haven't had any clarity on that yet. So I think this is the time you just pull back and wait it out.
And you go into treasuries. You said on this show a number of weeks back that this was the week that U.S. exceptionalism had peaked. And you talked about the dollar and the weaker dollar as part of that. And what we're seeing this morning is weaker dollar pretty much across the board, the euro surging the most going back to 2015. Deutsche Bank's George Saravello saying the safe haven properties of the dollar are being eroded. Do you think that that is fair to say as a theme going out for the remainder of the year?
Well, I think currencies are an excellent question. Thank you for bringing that up, because I don't believe that if you're China, if you're Japan, if you're Europe, you're going to let this happen. You're not going to have tariffs put in place and see your currency appreciate. So I wouldn't be surprised to see a coordination of trying to push the dollar back up. And how do you do it? Do you just pick up the phone and call the administration and say, I know you're upset about our tariffs, but we're going to help you out. We're going to buy a lot of treasuries. Do something like that, and that pushes the dollar back up. If you can push the dollar up 10%, that offsets about half of your 20% or so tariff.
That is not what's happening right now, that's for sure.
It's not. But we, as I said, we haven't seen any responses yet.
Bob Michele of JPMorgan Asset Management. Bob, it's good to see you. What kind of retaliation will we see? Headline crossed at a Bloomberg terminal just months ago. This came from the team. Germany and France pushing for a more aggressive tariff response. The latest reporting from the team here at Bloomberg.
Yeah, talking about how they should be ready to respond with options such as targeting U.S. tech and services. The French government wants to make sure that the EU responds with all its instruments to defend EU interests. They have come out, and really this, to me, was the quote of the morning. German Vice Chancellor Robert Habeck saying last night's decision is comparable to the war of aggression against Ukraine. The magnitude and determination of the response must be commensurate.
That's a shocking comparison. Absolutely shocking.
Which gives you a sense of why this is something that could escalate, even if a lot of people are saying, please let cooler heads prevail. This is a hit on some of the national champions of Europe, and you have to imagine that there are a lot of emotions right now.
That's certainly not going to help negotiations, that's for sure. Right. Equity futures on the S&P negative by 3.4%. Up next, Jim Zelter of Apollo, Bloomberg's Ollie Crook, Nela Richardson of ADP, and the former Trump White House trade official, Katie Kalutkiewicz. The second hour of Bloomberg Surveillance on the other side.
It's in the incentive of the U.S. to maintain ambiguity, to play a multi-round game.
Everything here in the U.S., we have the strongest hand.
The United States is a big, important country. That gives us leverage in the world. But we are not infinitely big and not infinitely important.
We have been in the process of destroying the American brand, and this hope that country after country would come and beg for a deal is changing rapidly.
This kicks off a negotiation. This is not the end.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance begins right now with equity futures plummeting. We're down by 3.4% on the S&P 500, the Nasdaq lower, the Russell down. The picture of stocks looks a little something like this. The Nasdaq 100 down by 4 percentage points, the Russell down by 4.65. In the bond market, a bid in treasuries, yields lower, down on 2s, 10s and 30s. We're down 5 on 10s to just north of 4%. New lows for the year in the last 24 hours. But in foreign exchange, earlier on this morning, we saw moves we haven't seen going back to 2015 on euro dollar. We pair some of that, but this is the takeaway. Coming into 2025 with a big consensus trade, long the US dollar. And if you get additional tariffs, that dollar gets stronger. Well, we got additional tariffs and that dollar is getting weaker.
In tandem with a weakening of risk assets, which is raising a question, is this a new paradigm? There was one economist, one professor who came out and said yesterday the U.S. has been at the center of globalization. Now the U.S., the center, wants to pull away. And there is a question about whether the dollar is a safe haven, or is this the opening salvo to get everybody in a tizzy? And then you come to some deals and we go back to something more akin to what we've known before.
So many different variables here. Can you negotiate it? How will others respond? Let's say it sticks. How will the cost be shared? We know by definition the importer pays the tariff. We've got all that. Is it taken on margin? Is it passed on to consumers? Can you put pressure on the exporters to drop their prices? Is it a combination of all of those things? The Federal Reserve has got to sit there and watch this play out for a number of weeks, a number of months, and wait and hope that it doesn't show up in the hard data anytime soon.
At the same time, if it doesn't show up in the hard data and you do get something akin to what Citigroup is looking for, a 4% rate on core inflation, how can they wait? How can they cut rates in response to weakness that hasn't yet occurred? And this is the conundrum. If you get a short-term pop in inflation at the same time that the hard data is lagging behind some of these indicators, it puts the Fed in a bind and is the reason why Morgan Stanley came out overnight and said they are removing their call for a June Fed rate cut because of this stagflationary type of backdrop.
Is the dovish bias constrained? Chairman Powell speaks on Friday going into the weekend. He knows where the tariffs are for now. They've not been implemented yet. He's going to have a decent idea of what the payrolls report looks like. What's the message going to be going into the weekend?
The dovish message that would send the market into a place of more comfort would be to repeat the word transitory. The idea that they are willing to look through any kind of short-term pop in inflation. If he says we have a dual mandate and we have to be very concerned that the inflationary pressures of the past can continue through, given some of the tariff pressures, that will set the markets into a very different type of tizzy, one that some people are talking about but is not getting priced.
And that address taking place in market hours on Friday morning. Equity futures right now in the S&P negative by 3.4%. Coming up this hour, we'll be catching up with Jim Zelter of Apollo as global stocks tumble. We'll speak to Nela Richardson of ADP on the state of the labor market, and we'll catch up with the former Trump trade official Katie Kalutkiewicz on Trump's tariff push. We begin this hour with our top story: the steepest American tariffs in a century. Annmarie joins us now with the latest from the nation's capital. Annmarie, how much of this can be negotiated?
Well, that's the big question this morning. Obviously, the hangover from President, what he is calling Liberation Day. Yesterday I was in the Rose Garden, Jonathan. He's outlining promises made, promises kept. He wants to see a global realignment. And to do that, he is putting a 10% base tariff, universal, or basically a ring around the United States. Key question, can that in itself be negotiated lower for, say, a country like the United Kingdom? That's the only tariff rate that they've received yesterday. Then on top of that, April 9th, you're going to have a more customized approach for a number of countries, including China, 34%. But when you take into account the fentanyl tariffs of 20%, that's more than a 50% rate for Chinese imports coming to the United States. The European Union, 20%. You have Japan, 24%. Can these rates be lowered is a key question. That comes into effect April 9th. Already, Scott Bessent, the Treasury Secretary, told me yesterday after the event that these negotiations almost already started. We have seen a flurry of diplomacy, whether it's the European Union, Japan, reaching out to the administration. Will we get a deal before April 9th, or is this going to take a lot more time? Terry Haines of Pangaea Policy says it may take a lot more time.
Annmarie, a lot of people on this show this morning are going to come on and have painted worst-case scenarios. They come on and tell us that essentially this prolongs uncertainty, increases the chance of recession. In Washington, D.C., among your sources, how different is the tone? Is there a sense of this is what we want?
Well, I think yesterday, just hours after the president unveiled these tariffs, you saw a number of Republicans, a handful, join with Democrats and push back on what the president did with Canada, using IEEPA, an emergency authority, to put tariffs on Canada, the U.S. neighbor in the northern border, the likes of Senator McConnell and Susan Collins. So you already see some pushback and some concern. I would say something is very key, and something I really picked up from my interview with Treasury Secretary Scott Bessent yesterday. Trump's agenda is a three-legged stool. You have deregulation, tax cuts, and tariffs. Right now, the tariff leg is what is crippling this entire agenda. And it is why you see the Treasury Secretary want to push ahead and try to get this tax deal done by the middle of the summer.
Annmarie, appreciate the update. We'll catch up with you a little bit later this hour. Joining us now for the next 30 minutes or so, the perfect guest, Jim Zelter, the president of Apollo Global Management. Jim, it's good to see you. Good morning.
Good morning, as always.
Congratulations on the new title, because I haven't spoken to you for a number of months.
Thank you. It's been a long journey, and I appreciate the note.
Well, let's get straight into it. You've called it macro paralysis. What is it now?
Well, it is. I mean, I sit here this morning, and this really can't be a surprise. The reality of the surprise is a little bit more painful for everybody to digest, but this administration was very clear during the campaign what their objective was. They really wanted to revitalize American industry. They wanted to bring back manufacturing, focus on energy, focus on industrial renaissance. And tariffs, as Annmarie just said, tariffs, taxes, and deregulation were the three-legged stool. And right now, the focus is on tariffs. They have been probably signaling, I know you're having Secretary Lutnick on later on this morning, but they've been signaling this was the dialogue. This is obviously a long negotiation, but again, this was part of the administration's agenda. This is what they wanted to accomplish. They've been very clear in the communication. So the pain of the announcement is being felt this morning in the market. But again, I'm not saying preaching patience and perspective, but certainly this should not be a surprise. And I think now, as we think about the big trends of the last 20, 30 years, the first of which is globalization. Globalization is not going to be like we have seen it in the past. It's a new global world order. How the U.S. manufacturing and financial base fits into that is a TBD, but certainly it's going to be one that plays out over the next several months.
I can't think of many people outside of you and the team more dialed into the C-suite in corporate America. How are they planning for the changes in the global economy that you and the team are anticipating? Are plans going ahead? Are they on hold? Are they totally derailed?
Yeah, listen, I've used the term macro paralysis because I think we came into the year, the busiest folks on Wall Street were supposed to be the M&A bankers and the ECM folks. And that has not taken place. And so the pace of broad activity in the public markets has certainly been muted. And I think this really plays into, and I've been on this show before talking about the role of public markets and the role of private markets, and not just private credit, but overall private markets. And you're going to see this be a turning point where private markets play a larger role for a lot of these corporates that are still, they have long-term plans, whether it's what's going on in technology, energy, mining, a lot of U.S. domestics. Who's going to finance this reshoring that's part of the master plan? So no doubt, I think, in C-suites and in boardrooms, there's vision, there's a desire, but the practical reality is things have come to a stop. And I know you're going to have Torsten on later on today. The soft data, when you see what's going on with consumers, consumer concern, corporate concern, it's really certainly, it's amazing what the president has been able to do in 75 days, what 400 basis points didn't do over 2 or 3 years. As I sat here a couple of years ago, we talked about the tightening of financial conditions. It didn't happen. The U.S. consumer led in a massive rally and a strength in the U.S. economy. In 75 days, talk of today has really slowed down the economy. So the soft data and anecdotes would tell you that we have, the recession went from a 1 in 5 to 1 in 3, that now, depending on who you talk to, it's north of 50%. It's probably 50% going higher, depending on what happens on the 9th.
There's a lot to unpack there. I want to go back to something that you said, that this shouldn't have been a surprise to anyone. And maybe the objective shouldn't have been a surprise, but the execution is raising some questions for people about how it is going to be passed through. Is there anything about what you have seen over the past week that makes you materially change some of your strategy about how you go forward, how you advise the C-suite?
Sure. Well, let's just go through 2 or 3 things about investing today. And a lot depends on the portfolio or the liabilities you manage. If you run a domestic U.S. long-short fund, this is obviously much more fundamental. We're a long-term, long-duration investor with a lot of investment-grade assets. So when you look around the globe right now, is anything cheap? Not really. Our rates probably going to be, notwithstanding the rate move in the last 24 hours, our rates going to be materially higher over the next few years than they have been because of deglobalization, probably. And then you have to weigh the geopolitics. So certainly your risk parameters and how you want to calibrate risk has certainly gone up the last several months. And the idea of the hurdle of an equity return has certainly gone up the last several months. And with base rates high and getting a coupon, it's all about your calibration of risk. So certainly this has taken a situation where, in terms of what you can get in base rates, in terms of bonds, in terms of fixed income, in terms of fixed income replacement, it certainly made the equity risk premium a lot higher. And certainly for us, we are in the private equity business, we are in the equity business. And for us, as risk premiums have risen, it's a really high hurdle for equity these days.
Which raises the question, especially if Apollo has really seen the debt portion of your business grow and exceed what you see in the equity. Is that only set to expand, especially if rates are going to remain structurally higher in this new regime?
There's a reason why we positioned our business the way we have over the last 5 to 7 years. Not suspecting a day like this would occur, but the reality is around the globe, you have millions and millions of folks that are ill-prepared, unfortunately, for their retirement and their pension. I was in Asia and Australia last week. Even as well as the superannuation funds have done for Australia, they do not really have a system on post-accumulation and post-retirements. And so around the globe, and even in this country, 11,000 people a day are becoming 60 or turning 65. We're ill-prepared for the pension system of tomorrow in terms of the needs. And that's why, listen, what's being written recently about private markets, certainly in Larry Fink's letter, it's a tune that we've been talking about the last several years about changing market structure, the role of private markets with retirement systems, financing what this administration is putting forth. We think we're primed to be at position of first in main in what's going on right now. But certainly it's a wake-up call for retirees around the globe.
We've got a lot to get through. I'm pleased to say that Jim Zelter, the president of Apollo Global Management, will be sticking with us. Let's just take a moment to check out the market. Equity futures down by 3.4% with an update on stories elsewhere with your Bloomberg Brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. We start with outgoing German economy minister Robert Habeck reacting to President Donald Trump's tariffs.
This is an extraordinary day for the world economy, comparable with the situation after the Russian aggression on Ukraine. And I think a similar reaction is necessary now from the European Union and its partners.
EU trade ministers will meet on Monday to discuss their approach and are preparing for further countermeasures if negotiations with the U.S. fail. Meanwhile, China also vowing to retaliate against Trump's new tariffs, which raise average U.S. levies on Chinese imports to at least 65%. The tariffs are expected to shrink Chinese exports to the U.S. by 80% and result in a 1 to 2 percentage point loss to China's growth. Economists are now predicting Beijing will ramp up stimulus to offset the impact. And let's get a check on Apple shares. Those are falling 7% in the pre-market. President Trump's tariffs will hit the company's supply chain and manufacturing centers in a number of countries. CEO Tim Cook had previously persuaded President Trump to exclude some Apple products from tariffs, but the new levies will still have a significant impact on the company. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the programme, the negotiating begins.
We are prepared to respond. We're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
We'll get you an update on those negotiations in just a moment. We'll catch up with Bloomberg's Ollie Crook on the ground in Europe, and we'll have more from Jim Zelter of Apollo from New York City this morning. Good morning. Equities down across the board here, negative 3% on the S&P. On the Nasdaq 100, down by even more. We're down by 3.7% on the Russell. We're down by 4.5%. Under surveillance this morning, the negotiating begins.
We have always been ready to negotiate with the United States. At the same time, we are prepared to respond. We are already finalizing the first package of countermeasures in response to tariffs on steel. And we're now preparing for further countermeasures to protect our interests and our businesses if negotiations fail.
So here's the latest this morning. The European Union vowing to retaliate if negotiations fail after President Trump announced a 20% tariff on EU imports effective April 9th. Bloomberg's Ollie Crook joins us now with more. Ollie, what's the latest?
Yeah, Jonathan, we should say that this is the higher end of what we were anticipating here in the EU policymakers. They were expecting something between 10% and 25% tariff. They ended up with 20%. And now the question for policymakers is, how do you respond? We understand that the Trump administration is not just looking for sort of the diminishing of trade barriers just in tariffs. They want to do also the non-tariff barriers, the non-monetary so-called, that Trump talked about a number of times last night. How do you even begin to calculate that? That is going to be the question for policymakers. And Jonathan, already you're getting some disagreement in terms of how to approach this. We've been hearing from the economy minister from Germany, Robert Habeck, who basically likened these tariff increases to having the same economic impact to the invasion of Ukraine by Russia. That is the rhetoric coming out of Germany. We also understand that the French are wanting to put up a much stronger fight and starting to begin to potentially target U.S. tech companies, services taxes, these sorts of things. That is emphatically not what the administration wants. It's what Scott Bessent has warned against. It's what Howard Lutnick has warned against. And again, we say all of this standing here in the NATO headquarters, where all of these European countries are extremely dependent on the United States being on board, both for their defense and Ukraine. So, Jonathan, a lot of different interests for these European leaders to navigate over these next couple of weeks.
Ollie, stay close. More from Ollie Crook later on today on Bloomberg TV and on Bloomberg Radio. Still with us around the table, Jim Zelter, the president of Apollo Global Management. Jim, let's talk about Europe. There's been a major sentiment shift towards the European side of financial markets and a pullback from the United States. For a long time, we talked about so-called US exceptionalism. And one big feature of that, maybe even the secret sauce, I think Jeff Bezos himself said it, is risk-seeking capital, abundant markets, really, really deep markets, tons of liquidity. Is any of that under threat?
Well, I think that what you're seeing is maybe not the U.S. Going down, but also parts of the other globe coming up. I mean, the Draghi letter that was put out last September that everybody had in the file, they've quickly pulled it out the last 3 or 4 weeks because certainly this administration has woken Europe up. And as they wake up, they're saying, how do we create an economic environment where capital can grow, capital be created for growth companies? Think about a securitization market. You've got a 23 trillion economy with a nascent securitization market. And I think this administration has woken up Europe in terms of thinking about how they actually fund, finance, and grow in this industrial renaissance that's going around the globe right now. So it's certainly been a massive wake-up call. And I think, again, you're going to see private market solutions for many of these countries, companies, and industries, not only in the U.S., but in Western Europe, as they rise to the challenge.
One discussion point has been that U.S. exceptionalism was predicated both on the AI trade as well as fiscal stimulus. That's going into reverse a bit, maybe. At the same time that the fiscal expansion is going on in places like Europe, in places like China, how much do you see that continuing in terms of market performance and something that you're willing to follow?
Well, what you're really addressing is mostly on the equity performance and the public equity performance, where public equity dollars go. Certainly there's been a massive amount of global investment in the U.S. equity markets, in the S&P, and that's going to be muted as there's a global pullback as investors think about other parts of the globe right now. But the bigger question which you're really getting at is, if a recession coming into, if I was here 6 months ago, we would have said a recession in 25, 26 was 1 in 5, and now that's certainly 1 in 2, if not higher, with what's going on over the next several weeks. The other scenario is the stagflation scenario. That went from a 1 in 6, 1 in 7 to probably 1 in 5 right now, 1 in 4. And that's the concern. That's got to be the concern of policymakers in the U.S., but also around the globe.
Just building on that, before it sounded like you didn't think the Fed could cut rates. You said that this is going to be a permanently higher rate environment, and that happens with both the U.S. as well as Europe. Why? You think that they're destined to allow that kind of scenario?
No, but I think they have when you look at the balance of the dual mandate right now, it's just certainly much more challenging. Certainly the White House is going to want to see them cut rates, but and certainly some of the economic data in terms of slower growth would portray that to be the next move. I think the Fed's going to have to practice much more patience in here.
Lisa, this is the number one question in financial markets right now. Is that Fed put constrained because of higher inflation further down the road?
Right now, the market is betting that no, it is not, because what you are seeing is more than 3 rate cuts, almost 4 rate cuts being priced into the market by year end, with some like Citi saying that they're going to accelerate them, and others like Morgan Stanley taking away their call. Key question at a time we're coming off a real inflationary bump.
Jim, we caught up with the Treasury Secretary yesterday in the immediate aftermath of the announcement from the president, and he was asked by Annmarie about the equity market sell-off since February, the highs of the year. And he pointed to the NASDAQ and said it seems like a Mag 7 problem and not a MAGA problem. Now, you can push back against that, pour some cold water over it, but he has kind of got a point. There's something else going on here outside of just trade.
Well, that goes back to my point earlier. Like, you know, when you look around, like what is an investor right now? Are things cheap? No, they've gone down in price. But don't confuse a price move with something being cheap. And it was a marketplace that the Mag 7 took the market up, and now the Mag 7 has taken the market down. But again, this is a very, very complex economy. And again, this is the big theme that we've been talking about for years. And I know we're talking about financial markets and the equity market, but these public markets only reflect a very, very small portion of the U.S. economy. Yes, these are great growth companies, they're global companies, but so much of the U.S. economy, so much of the European economy is private companies. And how do they navigate this? And that's what gives us a great deal of enthusiasm, because what's going on for investors in private markets, but also for companies needing capital, there's a lot more tools in the toolbox than there was a decade ago.
Can we just finish, though, on data centers, which has been a major theme, not just in public markets?
No doubt.
There have been some warnings about overcapacity in the last few weeks.
Yeah.
How are you and the team navigating that?
We've certainly taken on much more as a debt provider to date. Certainly those who've been around for a few decades, you feel like you're seeing a bit of the conversation about dark fiber from 98 to 99 and 2001, 2002. Build it and they will come. Certainly there are economics that still need to be developed in terms of the economic model of the data center business. A lot of capital has been created up front to purchase the land, secure the power, create the facility. But who is the long-term offtake of that? Who is the long-term capital? And again, this goes back to the conversation I had earlier about the pension deficit issue. There's a tremendous amount of long-term capital that wants to be matched up with that opportunity set. But to date, we've been much more of a debt provider. But I certainly think that questions that were raised last week by Joe Tsai, pretty legitimate questions about the long-term economics and the short-term supply-demand mismatch about how these things come online and what the economics are.
Jim, we could talk to you all morning. I know you've got a job to do, though. We appreciate your time.
Always
a
pleasure.
By. Thank you,
you,
Jim. Jim Zelter there, the president of Apollo Global Management, covering some major themes in financial markets worldwide.
At a time when suddenly the chances of recession, he said, 1 in 2 from 1 in 5, and the chances of stagflation, 1 in 3. This is the new discussion on Wall Street.
Equity markets colliding with that discussion. We're down by 3.4% on the S&P. Up next, Nela Richardson of ADP on the U.S. labor market. Payrolls just a day away from New York. This is Bloomberg. Where do you begin with markets this morning? Let's start with equities. Equity futures down across the board. We're down 3.4% on the S&P. Over in Europe, the DAX is down by more than 2%. In Japan, we close lower by 2.8%. That's the move in the equity market worldwide right now. In the bond market, we look like this. Treasury yields lower on 2s, 10s and 30s, down by around 5 basis points, which in the grand scheme of things is not a major move. But think about where the highs were. Back at the start of the year, around 480 on 10, so lower by about 72 basis points off those highs. Yields are down by 5 basis points on the session. In foreign exchange, that unlocks more dollar weakness. This was not anticipated. Coming into the year, we thought additional tariffs meant additional dollar strength. That was one of the consensus trades, and that consensus trade is being absolutely shredded. Euro dollar through 110, 110.60 up by 1.9%, dollar yen down to 146.40. That currency pair seeing a 2 percentage point move. I want to finish on crude. Haven't talked much about it this morning, but I'm sure it's on your radar. Crude down by more than 5%, Brent to 71. WTI to 67, and Lisa, moments ago, this headline from OPEC is going to hike output more than expected.
Yeah, they're expected to make a larger than expected supply hike in May, which will add to this decline that we're seeing in prices, adding to supply, adding 411,000 barrels a day. Key question here is how much will they try to lean into this to try to take the mantle away from the United States, given the fact that sort of OPEC plus and then the U.S. has really made up the difference for the past number of years.
Crude lower, Brent and WTI down by more than 5 percentage points. We're 2 hours away from the opening bell. Let's get you some morning movers. There are many. Here's Yahara Hacker. Say, Yahara.
Hi, John. We start with the retailers, both Walmart and Target getting hit, and Restoration Hardware absolutely plunging down 28%. And this is because so many of these retailers source their goods from China, and with a tariff rate of at least 65%, something's gotta give. Either their margins will take a hit or consumers will have to pay more at a time when they're already feeling the pinch. Next up, we have the automakers also falling here. Yes, they were spared from additional tariffs in this latest round, but that 25% levy on all vehicles imported from overseas is on, and it starts today. And I will note that, interestingly, Ford just announced that it's extending its employee discount to all customers as it tries to keep business humming. And last up, we have travel stocks also sinking here. The fear here is that tariffs will raise prices for consumers on goods, and they won't have any extra money or the confidence to travel. And apparently, no one wants to visit us here in the U.S., John.
Yahara, I'm sure many people do. Come on. Bramo.
You know, it's interesting. I was actually talking to somebody in the travel industry yesterday, and they were saying that Canadians are not.
I know, I've seen the numbers. It's
that's
brutal.
the big difference, is that Canadians are saying absolutely not, and they're looking at local resorts, but everybody else still is.
What's going to beat it? What else have you got?
Well, I mean, what, the United States?
Nothing better, Bramo.
Oh, my goodness.
On our radar this morning.
Who are you?
President Donald Trump announcing the steepest tariffs in a century, apart from Italy. Slapping 10% levies on all exporters to the US and even higher duties on around 60 countries, just for vacations. But we can talk more about this. The surprising thing wasn't just the Europe, Japan, China story. It was the places like Vietnam, which is what Yahara's been covering this morning. To see numbers north of 40% for Vietnam when you'd seen companies try and insulate themselves from the tariffs on China a number of years ago, this is becoming incredibly disruptive. And based on the numbers we saw yesterday, there's nowhere to hide.
I was also discussing last night, why start with Mexico and Canada, Mexico in particular, before getting to this level? And it is tied to the story of Vietnam, Malaysia, Philippines, the question of what are the backdoors that China's been using to get products into the United States. A real question here, and I mentioned this earlier, and this I think is going to become an growing theme. How much is this the United States forcing the likes of Vietnam, Malaysia, Philippines, Taiwan to choose between the United States and China in terms of their major trade partner at a time when they have benefited from being the connector country between the U.S. and China?
The Treasury Secretary, Scott Bessent, was doing the interviews yesterday after this announcement, catches up with Annmarie. Why isn't Mexico and Canada there? Don't know. I'm not part of the negotiations. Didn't seem willing to engage in this conversation about trade at all, and wanted just to talk about taxes. And taxes is where the focus of this market is going to be potentially over the next several months if we can negotiate those tariffs. Senate Republicans unveiling a plan to fast-track the renewal of President Trump's tax cuts. The plan would also increase the debt ceiling by up to $5 trillion. The Treasury Secretary wants us to talk about this morning, and not the tariffs.
As Annmarie said, it's the three-pronged stool, and this is a major prong of it. And if you just have the tariff prong, you end up with the recession calls and the stagflation calls that people are talking about. The new conversation, though, and I think Neil Dutta did a great job of Renaissance Macro overnight, is are these really tax cuts, or are they just simply an extension? Are they the sweetener or simply the expected status quo? And is there something that this Congress can do, given also what Scott Bessent said about the importance of fiscal restraint and paring back some of the government debt overhang? Is there anything this government can do to expand fiscal spending, given that focus and really right now the focus everywhere else of doing the opposite of the United States.
In 60 minutes, we'll catch up with the Commerce Secretary, and we need to talk to him about this story as well. The White House is close to approving the sale of TikTok's US unit to investors, and it might not be to Amazon. The Financial Times reporting Andreessen Horowitz, Blackstone, and other large private capital firms would own about half of the company's US business.
So the question here is, okay, who's the front runner? What does this process look like? What are the criteria? And then the other question is, how willing is China right now to use this as part of the negotiating tool with potentially lowering some of those tariffs that now are at a rate we are hearing at about 54%, or at least as of April 9th. A real question here about what the parameters are on both sides and whether this deal will be allowed to go through.
Who do these companies negotiate with? Who are they talking to? Are they negotiating with TikTok, with the president? Are they negotiating with the Chinese Communist Party? Who do they speak to?
Yes. I mean, I would guess that probably it's a several-tier discussion, but this is exactly the point. How does anyone get an idea? You're looking at U.S. Steel as an example. This is that on steroids at the same time that you have a Chinese government that's trying to figure out how to retaliate against the tariffs that the U.S. just announced.
What's the biggest criticism we've seen leveled against TikTok? They don't protect data. What have we just seen cross the Bloomberg terminal? TikTok faces a fine of over 500 million euros for EU data sent to China.
This is something that a lot of Congress members and globally people agreed was a national security concern. If this is a national security concern, why are we also talking about carve-outs where the algorithm is still controlled by China, which could allow this sale to go through? A lot of question marks, a lot of not understanding, frankly, what the different levers are that people are pulling.
This is one of those very, very busy mornings, so let's get back to it. Equity futures right now down 3.4% on the S&P. Some economic data later on this morning. We'll have jobless claims tomorrow. We'll have payrolls. We had challenger job cuts just moments ago, and Michael McKee has more. Good morning, Mike.
Good morning, John. Well, the Doge cuts are finally hitting the economy, at least according to Challenger. We have an increase of 204.8% in job cuts announced for the month of March. Remember, last month it was 103%, and that sent markets spinning. This is the biggest increase since May of 2020, and of course we remember what was happening then. You have to caution, of course, that Challenger, all the job cuts don't usually work out, and it isn't a completely accurate barometer, but it does suggest that we do have some trouble ahead, and Challenger says this is mostly Doge cuts in the private sector. It's not just government workers, it's also the contractors and people like that who are being laid off. So some sobering news about the labor market this morning, you could call it.
Mike, that's before we even get to tariffs. 20% on the EU, 24% on Japan, an additional 34% on China. Mike, we've seen sentiment crater. Are we going to see that bleed into the hard data as soon as this week?
Well, I don't know if we see it as soon as this week, because this week will largely reflect things that happened last month, but we're going to see it fairly soon. The thing about the whole tariff regime announced yesterday is we didn't get a lot of details about how this will be applied. So there is a range of views on Wall Street. Goldman Sachs thinks the average weighted rate will go to 18%. Capital Economics thinks 33%. You got a lot of people in between, in the 20s. But the point is, the Smoot-Hawley tariff rate was 20%. The average weighted tariff. According to a Fed model, in 2018, if you plug these numbers into it, GDP will fall by 2.3% and prices will go up by 1.5%. Then you ask, what is the effect on the individual? And it is, according to the Wall Street economists' overnight penciling, fairly substantial. Import taxes will rise somewhere between $400 billion and $600 billion. That would be the largest tax increase in decades, and it would take disposable income growth negative, according to JPMorgan. ING says tariffs will cost Americans an average of about $1,400, and the impact is going to be much worse on the bottom 60% by income. So you can see why Yahaira is looking at the retailers. There's a real feel here that Americans are going to stop spending, and that's why you see all these people talking now about the possibility of recession increasing a lot.
Mike, thank you, sir. Appreciate the update. Michael McKee with the latest economic data with more. Nela Richardson of ADP. Nela, good morning.
Good morning.
Starting points matter. Where's this labour market right now?
Solid. Someone helpfully left all of the economic releases here on the Bloomberg terminal, so I'm going to use this as well as the ADP data that we reported on Wednesday. We saw 155,000 jobs created in March. That's very good news for the baseline of the labor economy before this tariff announcement. But if you look at where the census for economists, according to Bloomberg, you see that initial jobless claims were low. Now, this challenger information will give us another data point, but we're still at historical lows when it comes to the expectation of layoffs over the next few months. And all the standards of the labor market have coalesced into a pretty solid number. Now, next week will be the reference week for the ADP number and the new government data. So next week will be important to watch. But for the month of March, we saw solid hiring across all firm sizes in the ADP data.
This is the challenge right now for the Federal Reserve. They're looking at the existing data and the existing economy that's showing signs of strength at the same time that the soft data is showing a rapid shift. DataTrek, Neil Collis over at DataTrek said that one feature of the labor market has been that companies have been reluctant to fire people post-pandemic. Have you seen any signs that that is starting to change?
You know, in the short term, Main Street can adjust to tariffs as quickly as the markets are adjusting right now. In the short term, production patterns are going to be sticky and consumption patterns are going to be very sticky. And that's what we're seeing broadly in the data. Yes, the headline number is solid. You're not seeing the effects of policy changes or even downbeat consumers in the headline numbers. Where you're seeing it is in the industry-specific channels. So construction hiring was much lower and weaker than we thought. That could be because input prices in terms of housing construction has gone up. It could also be because of labor shortages, which is a big driver of hiring in construction. We actually saw a boost of hiring in manufacturing for the second straight month. That was a surprise. Is this anticipatory hiring, trying to feed production before the tariffs really take hold of the U.S. and global economy? Maybe. We're seeing a slowdown in consumer-facing industries. So this all is to say that we're seeing an uneven effect in the labor market, but the top line number is still very good.
You have a lot of discussions with different corporate executives. You go around, you mine the data, both qualitative and quantitative, and I'm wondering what you're hearing about who people expect to absorb the cost. And it's a point that John has brought up. Are companies prepared to absorb it in margins? Are they going to pass it along? Or is it going to come in the way of job cuts and other types of cuts around the edges?
To answer this question, it's really important to think short term and long term, short, medium, and long term, and going from the macro policy to the locals. Because what a furniture, for example, manufacturer does in North Carolina will be very different than the response of a farm in California. Every company is going to absorb these impacts very differently, and you're not going to see it immediately in job loss. What you're going to see is a cutback in hours maybe, or a change in the compensation structure. Jobs will be the last to respond. So in the short term, I think companies are holding the line in terms of their headcount because it's so hard and so costly to make changes to their labor force. In the medium term, and I'm talking after the next 6 months, maybe a year or two, when these new policies really are cemented broadly, that's when you're going to see changes that are more permanent in terms of headcount, compensation, and hours. So right now, I think in the next couple of months, the labor market still stays okay. You might see a pickup in initial jobless claims as companies tweak around the edges, but they can't make big changes in a short period of time.
Macro paralysis, Jim Zelter, Apollo, it's the wait and see mode. The chances of it breaking adversely, though, from now, based on those policies that we saw yesterday, went up. And that's the problem this market's got this morning.
The bigger problem for the Federal Reserve, if it doesn't break for 6 months or 12 months, how do they justify cutting rates at the same time that inflation is picking up on the heels of ongoing robust consumer spending?
Nela, it's good to see you. to remind us that payrolls is tomorrow morning as well. Nela Richardson of ADP. Payrolls tomorrow morning, 8:30 Eastern Time. Equities lower with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. President Trump's tariffs on auto imports are already shaping pricing decisions for car makers. Volkswagen is planning to add import fees to sticker prices of its vehicles shipped into the U.S. Europe's largest automaker told dealers it would give more details by mid-April on pricing strategies for tariff-affected vehicles. Shares are lower 2%. Meanwhile, the White House is ending de minimis tariff exemptions, which allow packages worth less than $800 from China and Hong Kong to enter the U.S. duty-free. Ending the loophole is expected to have major impacts on discount marketplaces like Temu and Shein. The change, which takes effect on May 2nd, is part of an effort to prevent illegal or dangerous goods, including opioids, from being shipped into the U.S. And New York City Mayor Eric Adams is leaving the Democratic Party and running for re-election as an independent. Politico is reporting that Adams plans to mount a campaign tied to his voter base outside Manhattan, with an emphasis on ethnic minorities who helped elect him in 2022. The announcement comes after a federal judge dismissed corruption charges against him. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Thank you very much. The latest accounts out from the last ECB meeting. This is helpful. This is where policymakers are right now. Take a listen to this. Both a rate cut and a pause are on the table for April. Do they have to consider something else further down the line if we get bigger tariffs all over the place and more price pressure?
If it's an inflationary shock, do they have to respond in a same way that people have in the past that hasn't really done a good job? Stagflation is a very hard call for these central banks, and that could be what they're facing.
Inflation uncertainty could unfold either way. Tell me about it. Helpful. Up next on the program, the risk of retaliation.
I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number. So we've got a ceiling, and then we can see if there's a different floor.
Up next on the program, the former Trump trade official Kate Kalutkiewicz joins us next from New York City. This is Bloomberg. Live from New York City, counting you down to the opening bell, with equities lower by more than 3% on the S&P, down by more than 4% on the Russell. The Russell 2000 negative by 4.6%. Under surveillance this morning, the risk of retaliation.
I would advise none of the countries to panic. I wouldn't try to retaliate, because as long as you don't retaliate, this is the high end of the number. And I think the market could have certainty that this is the number barring retaliation. So we've got a ceiling, and then we can see if there's a different floor. The mindset might be to let things settle for a while, so we'll see where it goes from here.
So here's the latest this morning. Treasury Secretary Scott Bessent telling Annmarie the tariff rates announced by President Trump are the ceiling, as long as countries don't retaliate. Annmarie joins us now in D.C. And Annmarie, that's where things could get complicated.
Certainly can, Jonathan, because these tariffs come into effect April 5th for the baseline 10%, and then April 9th for the reciprocal, more nuanced version, depending on the country, say the European Union, for 20%. But what you heard there from the Treasury Secretary is that potentially this is the opening of a door for a negotiation. And for that conversation, I'm very pleased to say we are joined by Kate Kalutkiewicz. She is a former Trump White House trade official, and she was a trade negotiator in 1.0. So you understand exactly what's going on. I want to understand from you, is this really, truly the start of a negotiation?
Well, it depends, because, of course, if I'm on the other side of the table, I'm asking, what do you want from me? I mean, in some cases, it's black and white. It's a tariff reduction. But when we talk about these non-tariff barriers, or as the president calls them, non-monetary tariffs, it's much more challenging to imagine what that negotiation could look like.
When you look through this list the president presented, how did they get to these rates? Where's the data behind this?
Well, this is the question. What is the modality of how they calculated these rates? There's quite a lot of speculation that they're related to deficit numbers. The president, of course, cited tariffs, these non-tariff barriers, VAT rates, currency manipulation. So I think we have to dig into that a bit more.
Do you think we will, in the interim, if this is a true negotiation, I'm not sure it can get done by April 9th. Maybe it could. But in the interim, will there be carve-outs and exemptions?
Well, there were a number of exemptions allowed under these tariffs. So the White House last night issued pages and pages of exemptions, notably for products that are likely to face other tariffs because of a national security exemption. So we have new tariffs on cars, of course, but steel and aluminum are captured by new tariffs. And then the president has indicated new investigations into pharmaceuticals, semiconductors, ships, copper, lumber, timber. So these are all exempted at the moment until they have their new tariffs.
When you look at this list, China, number one on the list, USA discounted reciprocal tariff 34%. The past few weeks, we saw a 20% levy put on China because of fentanyl. On top of that, Trump 1.0 had around about 20-25% when it came to just phase one trade deal and other imbalances. What is the tariff rate at this moment if you're importing from China?
As of April 9th, as of today, of course, it's 45%. Then we will add in the 10 on Saturday, and then it will jump by 34%. So cumulatively, we're looking at around 79-80% tariffs on all imports from China.
Do you think that is negotiable?
I think eventually it is. I think the president, I think his legacy goal here is a deal with China. And so I think this is very typically Trump leveraging, right? He wants to come into those negotiations with the most significant leverage. And I think that's what we're seeing. The question is how China will respond.
Based on your past experience in the Trump 1.0 administration, how do you think China is going to respond to this?
I think they're going to continue to be calculated. We've seen them in each instance of tariff increases take a measured approach. They are showing the Trump administration that they're prepared to defend themselves, but they're not going to go over the top. They have started to reach out as well to allies of the United States, urging them to join together. And this is the interesting piece to me, because of course, if China starts to make friends with our allies around a shared dislike of Trump, this is a bigger concern.
Is that a red line this administration you think understands? If you're too aggressive, you might force allies to actually say, we're not going to put up the barriers you're asking for us when it comes to Beijing and then dumping on our markets. Is that a red line you think they understand?
I think some do, but I think the president articulated in his comments yesterday that, some of our friendly nations, he kept saying friends are foes and our friends are sometimes the worst. He is looking at this in a very bilateral way. Japan and Korea received fairly high tariffs. And he thinks, I think, that we can negotiate with them away from this. I don't think he's focused at the moment about the inroads China might make.
Kate, thank you so much for your time this morning. That was Kate Kalutkiewicz, of course, a former USTR trade negotiator, so understands exactly how the next few weeks may be playing out. What caught my attention from that conversation just now, the rate she's anticipating, accumulative, when it comes to China, Jonathan, 79%.
Amazing. Annmarie, thank you. A lot of confusion around that yesterday afternoon, Lisa, just how big these tariffs actually are. In addition to, inclusive of, and we're finding out it's in addition to.
And so suddenly you're talking about rates that would really decouple the biggest economies in the world.
Up next on the programme, Alex Altmann of Barclays, Tom Narayan of RBC, and the US Commerce Secretary, Howard Lutnick from New York. The third hour of Bloomberg Surveillance, up next.
We're just focused on tariffs, but there's a whole range of policies that are not growth friendly.
The rest of the world's watching mistake after mistake be made.
It's not a zero-sum game. It could actually be a net loss for the whole global order.
The majority of countries in the world, their main trading partner is China, not the United States.
Where is this leading to? One, I call it the Thatcher-Reagan. That's option A. Option B is Jimmy Carter on steroids.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Smoot Hawley on steroids last night, that's for sure. Live from New York City this morning. Good morning. The third hour of Bloomberg Surveillance begins right now with equity futures cratering on the S&P 500. We are lower. We're down across the board. Your board looks like this. Down by 3.4% on the S&P. On the Nasdaq, we're down by 4 full percentage points. In the bond market, we do receive a bit of a bid. 2-year, 10-year, 30-year. Yields are down 6 basis points on 10s to just north of 4%. New lows for 2025 in the last 24 hours. But in foreign exchange, the standout headline at the moment is this dollar weakness. The euro on course potentially for the biggest single day performance going back to December 2015.
This is a continuation of what we've seen, which is risk assets in the United States lower at the same time that the dollar, usually a safe haven, is weaker. And this is the reason why George Saravelos of Deutsche Bank came out and said the safe haven properties of the dollar are being eroded. There is a big gut check about how much the world order has shifted overnight with the overlay of tariffs that, as you mentioned, revert us back to pre-Smoot-Hawley times in terms of how much they increase the rate of tariffs in the U.S.
If you missed the fireworks as they were unfolding yesterday evening, it was messy. The Wall Street Journal came out with a headline and said new baseline tariff on all countries 10%. The market took that as okay, 10's not 20, good news by stocks. And then all of a sudden the president holds up a board. And on that board there's all these numbers. 20% on the EU, 24% on Japan, 34% on China. The equity market never looked back, cratered.
At this point, this is a worst-case scenario. That is what many analysts said in terms of both scope of the tariffs, but also the vagueness of them. It wasn't clear what the off-ramps were for each of those countries to come back and say to the United States, we will meet you where you're at and negotiate. That is the reason why people are having a hard time looking forward. Key questions here, there are a number of them. One, what kind of policy responses are there, both from the White House and the Federal Reserve? And two, at what point, when people came up this table and said uncertainty itself is cratering expectations and confidence, at what point is that now the new policy that people can factor in that will suppress risk appetite on a prolonged basis, even if there are some deals created?
So let's unpack some of that. So number one, sentiment hammered. Let's see if it spills into the hard data. We get payrolls tomorrow morning. 1, 2. The only ray of light this morning, the tiny little bit of light at the end of a very dark tunnel, von der Leyen of the EU coming out and saying, we will retaliate if negotiations fail. That is someone that's ready to negotiate, is the other side.
Yeah, and does she have enough of a quorum, given the fact that we also heard some pretty harsh words from Germany, for example, over in Europe? If that is a ray of silver lining, that gives you a sense of the tone on our show this morning. And, you know, there are people who are in the consumer sector who do raise the point about how globalism left a lot of people behind. At the same time, from a business perspective, to unwind all of this in a couple of days is leaving people wondering how you do this and how you even begin to negotiate. And that, I think, is the reason why people are having a hard time understanding the off-ramps from this particular tariff policy.
We've got some space and time. April 5th, baseline tariffs start. Higher tariffs begin on April 9th. That's the clock. It's ticking. Equity futures down by 3.3% on the S&P. Coming up this hour, Alex Altmann of Barclays as global equity markets sink. We'll catch up with Tom Narayan of RBC following 25% tariffs on autos. And later this hour, the US Commerce Secretary Howard Lutnick, 8:30 Eastern Time. That is a must-watch conversation taking place right here on Bloomberg Surveillance. We begin this hour with global stocks sinking following President Trump's sweeping tariff announcement. Alex Altmann of Barclays writing, this is essentially the worst case outcome. Bulls will argue we're at peak uncertainty. I am not convinced. Alex joins us now for more. Alex, good morning.
Good morning.
What would convince you?
Well, I think that we would need to see, quite frankly, a lot of evidence that it really is a negotiating ploy. And I don't really think that that's the case. I mean, the perfect case in point is from Tariffs 1. We had China, which was only, remember, 3% of goods. And in that environment, everyone said at the time, oh, this is just a negotiating tactic. And yet all of those tariffs are still here today.
So we got through the China story and we got through it okay, but we're in a different position now and the tariffs are higher and there are more countries. A lot of people are running around with this idea that if these tariffs stick, you're talking about an extra 1 percentage point on PCE by the end of the year. Is that the kind of number you're coming up with? It? Could it be worse than that?
I think there's two parts that could be worse. So I would actually look at it, really think from the economic growth perspective. So we've already taken down, we being Barclays economists, we're now forecasting negative growth in the fourth quarter of this year. So it's 160 basis point swing in the GDP trajectory. But I think that the bigger thing, which people aren't factoring in, is the wealth effect. So, you know, you've got half of US households that now own securities. Almost 70% of these households have their financial assets tied into equity markets. So the financialization of the US economy is far greater today. So the uncertainty point that you mentioned in terms of the impact that has on the equity market, I think that immediately feeds through the wealth channel, and that accelerates any kind of downturn that we may feel long before that we're factoring anything tariff related.
Is that the key point then from yesterday, is that even if some of these tariff rates are negotiated lower, the uncertainty that is going to be prolonged and the lack of predictability with the tariff regime has caused you to grow less optimistic about equity returns, particularly in the United States?
Absolutely. And put it really simply, uncertainty, as far as I'm concerned, is the killer of everything. You know, if you're a corporate, if you're a boardroom, uncertainty stops you from making those investment decisions. It stops you from making those hiring decisions. Sure, of course, from a tariff perspective, we can say, okay, I'm being incentivized to bring manufacturing onshore and so on and so forth, but that doesn't happen overnight. And we could actually see again from the first experience under Trump with certain corporations, they promised a lot and actually ended up delivering a lot less. I think Hon Hai being a case in point, Ford being another case in point. And so this uncertainty to me just is going to weigh on that consumer sentiment. We've already seen it so far this year, and I just think that what happened yesterday will make it a lot worse.
The assumption coming into this year was that the United States would get hurt less than the rest of the world. What we have seen so far this year is anything but, is sort of the opposite trade, with Europe outperforming the United States by more than 17 percentage points. I'm talking about the equity markets. Is that a trend that's going to stick? And I say that at a time where the dollar is weakening at the fastest pace versus the euro going back to 2015.
I think it's pretty unclear. So we came into the year with a very strong view of US exceptionalism as a tactical short. That was our view, and it was a pretty controversial one. Today, I think that the issue is that I think we need to go back to the old phrase of if the US sneezes, the rest of the world is going to catch a cold. And so if the US is going to be in a waning economic environment, then it's most likely going to drag the rest of the world with it. And so I think that the interconnectedness, we can sort of say that we want to go back to a Smoot-Hawley environment of higher tariffs of the 1930s, but the world is much more interconnected today. And so what my concern is that people talk about repatriation flows back to their respective countries, but the interconnectedness of the US and how important it is from a capital markets perspective means it probably will drag along everyone for the ride.
I'm pleased you brought this up because we've started to see this weakness develop elsewhere. In Japan, again, overnight, the Nikkei down by 2.8%. As we speak, the DAX is down by 2 full percentage points. Are you saying those European longs that have accumulated over the last few months should probably get a little bit more uncomfortable in the weeks to come?
So in the answer, yes. And I think there's a couple of reasons for that. Number one is that the opportunity set of that big valuation gap between Europe and US is contingent upon that opportunity set, i.e. the valuation gap being sufficiently attractive based upon an ROE differential, let's just call it. That gap has largely closed, and it closed in record speed, which leads on to the second point. Why did it close at record speed? It's because if you're trying to move money out of the United States, we've got a $60 trillion market here. You look at any other market globally, it's orders of magnitude smaller and also orders of magnitude harder to trade. So trying to move money also is going to have a profound impact on those respective markets, which just make it less interesting if you're a large financial institution and you're being like, okay, I don't want to be in US equities anymore. You have a problem. Where do you go?
So tactically, where do you go?
I think within the US, you effectively have to go responsibly within two parts. Number one is you have to go within quality. And I don't think that's anything particularly new. So strong balance sheet versus weak balance sheet, just thinking about the path of if interest rates can't come down as quickly as we would have hoped, then what does that mean for the leveraged loan market? What does it mean for the BDCs and that part of the market as well? So strong versus weak balance sheet, that's a pro-quality trade. The other one is we need to start thinking about value again. So are there parts of the market that already are factoring in a higher degree of recession, or providing that, to use Buffett's phrase, margin of safety, that other parts of the market are not? So the market writ large is trading on, 21, 22 times, depending on what EPS we're using for these downgrades. There are parts of the market that are still trading very cheap, and there's also international equities trading very cheap. Mexico, for example, 8.5 times. Turkey, also a relatively cheap market. There's esoteric parts of the world which we might have to just dig a little bit deeper to try and find something interesting.
Didn't like the Turkey point?
Well, it's not what I expected. I'm thinking of all places to go. Turkey, wow. I mean, it just shows that, redefining undervalued.
We're searching for the silver lining, Kit.
Exactly. Thank you.
Alex, let's finish on this. Who do you think blinks first, the White House or the Federal Reserve?
I think that's a great question. And personally think that it's going to have to be the White House. And I think the White House is operating, so the way we're thinking about it is twofold. The Fed are operating under a put driven by the credit market. And the White House is being driven by a put that is time driven, not strike driven. So they're operating on the assumption that they need to think about midterms. They need to be thinking about a recovery in the economy and people feeling good for 2026. So they're actually operating under more constrained capacity in terms of like, okay, how do I get that inflection point for next year? So I personally think that it's going to be the White House that comes to the negotiating table first. And the Fed will be operating under the function of if the credit market balks, loans, BDCs, so on and so forth, then I suspect that will be when they step in.
Smart framing. Alex, it's good to see you. Thanks for dropping by.
Thanks very much.
Alex Altmann of Barclays. Underperformance stateside within the equity market in the United States. Apple down something like 7 or 8%, seeing big moves lower in the likes of Amazon, down by something like 6 percentage points. Likewise for the likes of Meta, down by 4, 5% too, just across the board. Mag 7 stocks getting hammered again this morning.
Because they're the ones that have that international footprint. And by the way, if you want retaliation, how much they become the targets, the poster children of America that say China can go after. There's a key question here as you go forward, which is, where does the Trump administration respond if they're trying to cater to this sort of nationalistic feeling and corporate America is viewed as a globalist entity that isn't necessarily the champion that they want to support? I'm serious. It doesn't work with the narrative that they're trying to put out there that we've got your back, you workers. And at a certain point, you wonder how much that's going to stymie how quickly the Trump put is going to come into place.
Equity futures this morning recovering just a touch. We're down by 3 full percentage points. The opening bell 1 hour and 17 minutes away. With an update on stories elsewhere with your Bloomberg Brief, here's Yahara Hecker. So, Yahara.
Hi, John. TikTok owner ByteDance is facing a fine of over 500 million euros for illegally shipping European users' data to China. The fine comes after a lengthy investigation found TikTok violated the EU's General Data Protection Regulation. Now the regulator will order TikTok to suspend the unlawful data processing in China within a set time frame. Meanwhile, Russia is counting on President Trump to deliver an acceptable peace deal in Ukraine, but according to people familiar, it's prepared to continue the war if talks fail. Those sources also said the Kremlin is unconcerned by Trump's threat to slap punitive secondary sanctions on Russian oil over the lack of progress toward a ceasefire. And U.S. crude futures are falling nearly 6% now, trading at $67 a barrel following President Trump's tariff announcement. And OPEC Plus deepened the slump, saying it would lift output by 411,000 barrels a day in May, more than previously announced. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara a little bit later. Up next on the programme, the Morning Calls Plus, Tom Narayan of RBC on the impact of the 25% tariffs on autos. That conversation up next, live from New York. You're watching Bloomberg TV. So many different calls so far this morning. One of the standout calls that we've had, Bob Michael, JPMorgan Asset Management. If these tariffs stick, this Fed will cut. That's his view. This Fed will cut down to a 2 handle from the 4 it's currently at. Lisa, that's what this market is wondering, whether they can, whether they will.
Bob said this is not your Volcker's Fed. This is a very different Fed that is clearly attenuated to the risks of a downturn. This is the reason why Fed Chair Jay Powell is going to be so important to listen to on tomorrow, actually, after the jobs report. He repeats the word transitory. Well, that Fed put just got reinstated.
I imagine that's what the market wants to hear. Will it hear it? Equity futures right now in the S&P down by more than 3%. On the Nasdaq down by 3.7. The Russell negative 4.5. Let's get some morning calls. First up, Citi upgrading TJX to buy, saying discount retailers will benefit from tariff disruption. The stock is down by 0.8%. Your second call, Bank of America lowering its price target on Apple to $250, pointing to steeper tariffs on China, on India, and on Vietnam. That stock is down by 7.5%. And your third and final call from JPMorgan, cutting its price target on Wells Fargo to 73.50, expecting banks to be impacted in numerous ways by tariffs. That stock is lower by more than 4%. Let's head down to Washington, D.C. and catch up with Annmarie. Annmarie, you know the dates. We've talked about them repeatedly. Baseline tariffs start on April 5th. Higher tariffs start on April 9th. Auto tariffs have already started.
That's right. Auto tariffs, those take effect today. And one thing to note, though, given the fact that we are talking about the baseline 10% and the reciprocal tariffs the White House announced yesterday, those auto tariffs will not be on top of that. They won't hit also the reciprocal tariffs. We're talking about a 25% when it comes to auto imports. Few things to note. One, the European massive giants are already looking at adding import prices to this, so basically passing it immediately on to the consumer. And others, like Mercedes-Benz, is looking at, can they do more in the United States? That will be music to the ears of President Donald Trump, who's been talking about wanting to bring more manufacturing into the United States. I will say, though, we also have the likes of Ford, GM. The lobbying effort continues in Washington, D.C. They are calling the administration and trying to get carve-outs and exemptions for some of the components that go into these cars.
AMH, more from Annmarie coming a little bit later. Annmarie, thank you. We'll be catching up with the Commerce Secretary, Howard Lutnick, in about 12 minutes' time, so look out for that. Let's stick with autos. 25% tariffs on imports taking effect shortly after midnight last night. Tom Narayan of RBC writing, we have more clarity we didn't have before, but the market is not pricing in permanent tariffs. The scenario makes us like Ferrari more, while we think Tesla benefits on a relative basis. Tom joins us now for more. Tom, welcome to the programme. Is that outperformance in a down market, or are those stocks actually going to finish the year higher?
It's probably more a relative call. I mean, the tariffs will be a net negative across the board. It's undoubtable. But if you look at how these stocks are trading, it would appear, certainly, especially the D3, they're not pricing in permanent tariffs.
How much, Tom, do you think that there is a message in the fact that Mexico and Canada were not included yesterday in the retaliatory tariffs, opening up maybe room for negotiation with some of what's going on in autos today?
Exactly. We think that's actually very true. And obviously, I'm not a political analyst. I'm an autos analyst. I can tell you what investors are saying, and they certainly think that this is potentially opens up room for renegotiating USMCA. Recall, the D3 is already largely USMCA compliant, which means North American content. Question is obviously U.S. content, but they're already at about 50% U.S. content. It's just the other 50% that could be tariffed at 25%. If they could negotiate that down, that would be a big boost to them.
Yesterday, President Trump was saying that there'll be 0% tariffs if people move their production to the United States. This morning, Mercedes came out, said they were contemplating possibly moving some production to the United States. How feasible is that type of shift, and what is the time frame that you could foresee?
Yeah, it really depends on the OEM. Mercedes obviously has their plant in the U.S., so does BMW that makes SUVs. A lot of those get imported to Europe. But certainly you could add shifts, et cetera, to expand that production footprint. That's not as difficult, let's say, as GM. Building a brand new plant in the U.S. would take not months, but several years. We're talking 3 to 4 years. By that time, you could have a new administration that takes office. So less likely for a brand new plant to be built in the U.S., more likely for extra shifts or lines to be built for, let's say, a Mercedes or a BMW.
Tom, how many manufacturers do you think will just exit this market? We had this conversation earlier on this week, and we had an analyst, I believe, from Bank of America, John Murphy, wasn't it?
Yes.
Earlier this week, yeah. Long week. John came on the programme and John talked about whether some companies would just exit the low end of the market. And I wonder, Tom, whether you share that opinion and how you think some of these policies will actually reshape the auto market in America in adverse ways.
Yeah, I mean, the U.S. market is a big market. It's kind of hard to get out of it completely. It's dominated by the D3 anyway. But yeah, the Japanese and the Korean players, it does beg the question of how big they are in the market longer term. They tend to compete with each other, not with the D3. That is interesting. Also, their imports are predominantly on the premium side. Let's say, you know, like a Lexus for Toyota, et cetera. They compete against each other. So maybe you get less of those. Again, all of this presumes a structural tariff that continues. We're not sure that's really going to happen. But for the most part, if you're already in the U.S., you're going to want to stay there. It's a very important market, especially what's happening in China and Europe. You'll see some stuff on the fringes, but unlikely to see huge changes, I would say.
Tom, why does no one believe it? I think that's what's interesting about this morning. Very few people have come on this programme and said it is their base case that these tariffs actually hold. Where does that belief come from, Tom?
Well, it comes from the fact that, yesterday's news excluded tariffs. And actually, the tariff announcement last week on autos was, in some people's minds, there is a silver lining there. It talked about examining U.S. contenting, right? In the past, we didn't know what happened to a Chevy Equinox, where the battery comes from the U.S., but it's assembled in Mexico, and then it's shipped to the U.S. Now we know that the administration says they're going to calculate how much U.S. content there is. We think, and investors seem to think, that this is potentially a negotiating tool for the future to increase U.S. content, as opposed to an outright 75% tariff. The other thing we know is the automakers are talking about the fact that they'll increase pricing. They won't just simply absorb the tariff altogether. When you run the math on that, it's not as painful as it would be if the OEMs just absorb the tariff entirely.
We've been discussing, Tom, what the end game is here. And some people have speculated that it's a true decoupling of the U.S. and China, including removing some of those connecting countries like Vietnam, Malaysia, Thailand, et cetera, that have been doing the production of a whole host of different manufactured bits. I'm just wondering, Tom, given how integrated the supply chain has been, given how much Chinese manufacturers have moved into China, into Vietnam, into Malaysia, how feasible do you think that kind of decoupling is?
It's very difficult. The supply chain is so global as it is. I mean, you're talking even the supply chain within the supply chain, right? Suppliers even that make, let's say, wire harnesses or seatings, there's components in there that come from different countries. Even companies that potentially benefited in some way on a relative basis from this tariff announcement, who produce entirely domestic, have a ton of parts that are sourced, from overseas. So that decoupling that will take even longer potentially than even setting up plants in the U.S. You may see some suppliers change, let's say instead of Mexico, Honduras, or what have you, maybe in the hopes that that will sweeten the deal, let's say, better with the administration. But there simply isn't the labor force in the U.S. to do some of these jobs. Creating that takes years. So unlikely that will decouple. That's just the world we live in today. It'll be really difficult to go back from that.
Hey, Tom, appreciate your input. Busy week for you, I'm sure. Tom Narayan there of RBC. Lisa, I wonder what it would take to convince people that this was actually going to happen. The tariffs have gone on overnight, and yet still, analysts in the auto sector don't believe they stay. After a week, after a month, after 2, after 3, at what point do they believe that this is going to hold?
It's a great question. Ultimately, at what point do people give up the hope of a Trump put where there's going to be some response from the administration trying to jawbone markets a little bit higher?
That hope takes a beating overnight. Equities are lower by more than 3-4 percentage points. Up next, a major player in President Trump's tariff announcement, the Commerce Secretary, Howard Lutnick, live on Bloomberg TV. Equities right now negative by 3.4% on the S&P 500. On the Nasdaq, we're down by 4 full percentage points. In just a moment, jobless claims data ahead of payrolls data tomorrow morning. Going into that, your bond market looks like this on a 2-year, 10-year and 30-year. Yields are lower by 8 basis points on 10s, 4.05%, and the euro is cratering for the dollar side of the trade. Euro dollar right now, 110.85. Euro stronger, a 2 percentage point move. Let's get to Michael McKee with some economic data. Good morning, Mike.
Good morning, John. Well, we're getting the latest jobless claims numbers, and they're still way in line with a strong labor market, 219,000 for the last week, and only 564 federal employees filing for unemployment benefits. Remember, they're in a different category, so we are not seeing the Doge effect yet there. We're also waiting on the U.S. trade balance, which comes in at a negative $122 billion. That's down from 131 billion last time. We'll have to get the breakdown of the imports and exports and the trade balance for various countries, but I'll send that along as soon as that gets parsed out.
So, Mike, good news. 219 is not terrible. The starting point going into these tariffs, the labour market still looks OK. Going into tomorrow morning, Mike, what do you expect to see at 8:30 Eastern Time?
Well, right now, we're not expecting to see a whole lot of change, maybe a slight decline in hiring, but the government numbers aren't expected to fall for the same reason we're not seeing a big change in government jobless claims. It's just very confusing as to who's got a job and who doesn't. Challenger just taking the announcements from the federal government about how many jobs they're going to cut as opposed to the actual number of jobs. So it may happen, but it's going to happen perhaps next month rather than this month.
Mike McKee, thank you, sir. The latest with claims. Lisa, no bad news there on jobless claims going into tomorrow morning.
The only negativity that you could really find there is that continuing claims rose to the highest level since 2021, but pale in comparison to what we saw in the aftermath of the pandemic. Look, as Nela Richardson said, you're not going to see those layoffs in the near term. Companies are doing pretty well, and they are passing along that with a strong, robust labor market, raising a question of when the hard data will reflect what we're seeing in the soft data.
If you are just joining us, welcome to the programme. The opening about 58 minutes away. The equity market down across the board on the S&P 500 negative by more than 3%. As you know, our top story worldwide, President Donald Trump unleashing a major tariff push, imposing levies on all of America's major trade partners. The Commerce Secretary Howard Lutnick playing a key role in President Trump's tariff announcement just last night. The Commerce Secretary joins us now for more. Mr. Secretary, thank you for making time for us on a busy morning for you and the team. Appreciate it as always. Let's talk about those deadlines, those dates. Baseline tariffs start on April 5th. Higher tariffs start on April 9th. What happens between now and then?
Well, we are talking to all the trade ministers, but nothing really happens between now and then. What CEOs are thinking about is finally, let's think about building in America. You've got almost $5 trillion of commitments coming to America to build their factories. That number's only going to grow as people realize it's time to bring manufacturing home to America, where the greatest economy and the greatest market in the world is. It's time for America to stop taking care of every other economy in the world and building them up. Let's build the American economy up. Let's build American GDP. And you're going to see great growth from America.
Mr. Secretary, as you know, capitals around the world watching this programme right now want to understand what they can do between now and then to avoid those tariffs. What do they need to do? Have you communicated any metrics to them whatsoever?
Well, we've been talking to the trade ministers of the major trading partners for more than a month, and we've been talking to them. And so you have to understand, and this is what's difficult for your audience to understand, that tariffs are easy to understand, right? We have a 2.5% tariff on autos, and Europe has a 10% tariff, and other people have a 20% or 15% tariff. And that's sort of easy, so they can all come down. But it's the non-tariff trade barriers that are the difference. Some countries have a VAT, and they take that VAT tax of 20%, and they use it to subsidize the production of their domestic industries. That's why we can't sell cars there, because they give a rebate. Either they give it directly. One country told me yesterday that they give it directly to their car manufacturer to make their cars cheaper. That's why they sell successfully and we don't. Others take the money and use it and give cheap energy costs to this production. And that's why the steel industry, why is everybody else so good at steel and we're not? It's because their governments subsidize it. So we really need to change the way trade works around the world. It's tariffs, but don't get confused that these non-tariff trade barriers, they are the monster that needs to be slayed.
You've been consistent about this argument. Subsidized production, manipulated currencies, foreign trade barriers, something the president addressed just last night. Can we just sit on the numbers just for a moment? The EU, 20%, 24% on Japan, 34% on China. Just what exactly was the methodology to go through all those different barriers to entry that you want to knock down? How did you come up with these numbers?
Well, the Council of Economic Advisors, the PhD economists of the administration, coupled with USTR, the United States Trade Representative, they publish a book called Trade Barriers. It's about this thick, right? And they've been analyzing for decades all of these different tools that these other economies use to hurt America, right? They won't take our corn in India. They won't take our beef almost anywhere. It's unbelievable. They won't take our agricultural products. They just treat us badly because we've allowed them to treat us badly. And when you finally go back at them and say, this has got to end, it's going to be tough for them because they've built their whole social network, their whole economies on basically exploiting America. And Donald Trump has said it's time for America to change that. It's going to be difficult for them to change that. But eventually America is going to be treated fairly, and the production of American factories is going to be incredibly strong growth. Yeah. And you're going to see that growth reverberate through GDP. Remember, people forget the D, gross domestic production. If you buy a foreign-made Toyota, that is not domestic production. Making a car in America, that's domestic production.
Mr. Secretary, if we could just sit on the methodology just for a beat longer and address it directly. This is what we understand, what most people understand you did, that essentially you divided the country's trade surplus with the United States by the total exports and then divided the number by 2 and produced this discounted rate. If you're a trade partner right now and you've just watched how America has put together that policy, how are you meant to negotiate with that? What are those countries meant to say? What are they meant to do?
The countries understand that their trade policies were an exploitation of America. Everybody understands. One country actually said to me, I was amazed that we were able to get away with it for this long. I mean, imagine that.
Can you share that country with us? Because they don't say this, they never say this on the record. You've got the potential, the option, the ability right now to share that with us directly. Of course they're not going to say it on the record. Who's saying that to you?
No, come on. Oh, stop. I mean, the country, one country told us that they give the subsidy to the car companies. Another country admitted that they give their subsidy to their steel companies. I mean, they're not going to repeat it on here. What's on here is that this is going to change, that it's time for these things to change. And they're going to be more fair. And America is going to do well. And in the middle of that time, all the factories are going to come back to America. You're going to see an enormous number of factories come back to America, or you're going to see incredible change globally. It's going to take time, but the factories are going to be built in America. That's the most important thing. Donald Trump wants to see steel and aluminum made in America so we can defend ourselves. He's going to want to see pharmaceuticals made in America. Who on your audience doesn't want us to make the ingredients for pharmaceuticals? Did anybody ever ask themselves why the ingredients for drugs should be made in China? Why is that? That's not cheap labor. That's high-tech factories in China. Why? Because their government helped create it. They created cheap goods there. They oversupply them. They drive the capitalist American who don't think like this out of business, and then they make it in China. And Donald Trump has said, I've had enough of this.
I think, Mr. Secretary, most people would totally agree with you. They would totally agree with you because China is an adversary. It is not a partner for the United States. Europe would make a very different argument. And Europe might be wondering this morning why they're being thrown into the same bucket as the Chinese. What explanation can you give them?
Europe does not treat our products fairly. They do not treat our companies fairly. They treat themselves incredibly well to the detriment of the United States of America, right? It is time for them to treat us fairly. And that is the point. It's not free and fair trade. Their tariffs are higher. The non-tariff trade barriers are incredible. Like, I'd ask you, why don't they take our beef? Why don't they take our agricultural products? Why? Because they don't want them, because they want to make the money themselves. Why is it okay for every other country to feel this way, and it's not okay for America? I tell you why. Because we were the world's piggy bank, and Donald Trump has said our $36 trillion deficit, our $1.2 trillion trade deficit, $1.2 trillion. We buy other people's things more than we sell them ours. Has got to be rebalanced. It's a national emergency. Let's fix America. and we can.
Mr. Secretary, for you it's beef, for the president I know it's Ford and Berlin's, but there are products that Europe takes, things like LNG, things like Microsoft services. Do you want to see balanced trade product by product?
No. It's not product by product. It's a big macro issue, okay? Fairness comes when one decides that they can stop, they can't get away with it any longer. So let's make a great deal with the United States of America, okay? They've got core issues. They have a VAT tax of 20% or 20. Europe has 21%. I mean, so when our goods are sold there, we pay 21%. They say everybody pays that. And then they use that money to beat us down in other ways. I mean, come on. We need to have fair trade macro, not product by product. But I think that the way Donald Trump looks at it is country by country. And what's going to happen is you're going to see domestic production grow. You're going to see interest rates come down in America. You're going to see growth in America, great jobs in America. Robotics is going to come to America. It's going to replace cheap labor overseas. Robots can make things. And you know what the job is going to be? Mechanics who fix robots. Kind of like a high-end BMW, robots are going to need to be fixed, and those jobs are going to be high-paying jobs, and they're going to be here. We're tired of them being overseas.
For some countries, there's the 10% base, and that's the only levy that they were hit with yesterday. I'm thinking of the United Kingdom, I'm thinking of Australia. But those countries have a trade surplus with the United States. So why put the tariff on?
Well, I think the president understands that all of these countries, even if they have a trade surplus, if you dig into it, like, for instance, the UK, their trade surplus counts that they have this London Metals Exchange, and so gold and silver bullion going in counts. I mean, come on, that doesn't really count. So, and Australia, which is a wonderful partner of ours, they buy a lot of our planes, right? And if you buy our commodity gas, I mean, that's really what you need, not really what we need to sell you. It's not the same. So the president decided, why don't we have a baseline of 10%, okay, to really understand that everybody needs our economy. Our economy is the magnet of the world. Everybody needs our economy. Let's them pay coming in, and let's change that deficit of $1.2 trillion, and let's make America's economy grow, and let's balance that out. Let's fix that first, and then we'll go readdress the rest of the world. But we need to fix our trade deficit. $1.2 trillion. It's unbelievable why we don't have those jobs and the rest of the world does.
Treasury Secretary Scott Bessent told me last night this is a ceiling. Potentially we can see a different floor. Are you prepared to negotiate all of these rates? Is this truly the start of a negotiation?
Well, it's the start of a rebalancing of the way the world works. I agree with the Secretary that our view is that the only way these rates are going up is if countries decide to retaliate. But why would you retaliate against your biggest client? Your biggest client says, I want to reorder things. I mean, the United States of America is the largest client in the world. And yes, of course the countries are going to talk to us, but they talk too casually. They always talk about their tariff rates. I mean, it's like they say, oh, I'm going to cut my tariff rate. You think the reason we don't sell a car is because Europe charges a 10% tariff and we were only charging 2.5%? That was outrageous. But the key is they have all these rules. Like one of my favorites is the Koreans. When we made a deal with them in 2012, we took their cars, right? Kia and Hyundai, and we were going to sell agricultural products to them, right? And when McDonald's went to send in French fries, they wouldn't let them go in because we couldn't prove the origin of the potato. I mean, you don't understand the scale and depth of how they keep our products out. And Donald Trump has said, I've had enough. We are going to be treated better. America is going to be treated better. And that starts today.
Mr. Secretary, why exactly wasn't Russia on that list yesterday?
Because we have sanctions against Russia, North Korea, Belarus, and Cuba. And so we're not supposed to be trading with them.
Thanks for clearing that up. The additional question that other people had too about Mexico and Canada, they were also noticeably absent. Why were they absent?
Well, they are operating under a rule that was set for fentanyl, right? That they needed to close the border and stop fentanyl. And what that rule is that USMCA, right, the major trading is exempt, right? And the other products that they do have a 25% tariff. When that is resolved, so we're not going to double count it. That's just not the way it works. When that's resolved, they will fall into a model like this. But I think USMCA, in the order, USMCA continues to be exempted. So car parts, for instance, don't come with a tariff if they end up being finished in American cars. So if you're building your car in America and you're getting parts from Canada and Mexico, that's fine. The American cars still come with no tariff.
Okay, that's helpful. The additional question we had on just a few numbers, because we're all trying to make sense of this in real time, and you've got the numbers. What's the tariff on China now? The complete tariff, including everything. What is that number now?
Well, there was a 20% tariff because they continue to make the ingredients for fentanyl and send them out, right? And those ingredients have the highest subsidy rate in China, meaning the Chinese government is paying these factories to make these goods, the ingredients for fentanyl, which is killing Americans, right? So Donald Trump put a 20% tariff on that, and now the regular trade deficit number, right, the analysis by the Council of Economic Advisors and the United States Trade Representative, we have a 34% tariff, so it's 54%. But when they stop making the ingredients for fentanyl, and I want to point out in 2019, President Xi told President Trump that he would put the death penalty on anyone who made fentanyl. And now he's actually subsidizing them. And that's just so wrong that Donald Trump is just, he's not going to stand for it. And he's got to hit them with the only thing he can
Secretary
hit them
Lutnick,
with, which is economic
on China
penalty.
On China as well, what about the 301 tariffs that were put in place under Trump 1.0 and then carried on to the Biden administration? That's about 25%. Are those still in place? Do they get added to this cumulative number?
They do indeed, but those are on specific product segments, and those still are as well. Autos are not.
So we're
on
talking
top
about
of.
79.
So
we're talking about
in
79% for some imports, cumulative. We're talking about a 79% tariff from China. Is that accurate?
On certain products, that could be true, sure. But they've got to stop
the
fentanyl.
UAE.
All they have to have is a phone call. All they have to have is a phone call from President Xi to President Trump saying, I'm going to end fentanyl production that's killing Americans, and it drops 20%. I mean, that's a pretty inexpensive phone call, but you have to make the decision. You're going to stop killing Americans. And so far, they haven't made that decision. Shocking, but they haven't made that decision. And you really got to think about that for a minute. Think about that for a minute. A phone call would save them 20% on all their products, but they'd have to stop making the ingredients of fentanyl, and they refuse. Outrageous.
Has your counterpart reached out to set up that phone call between President Trump and Xi Jinping?
You know, President Trump and President Xi, they have their own way. They're not going to be, when that phone call gets made, I don't think they're asking me to set it up. I think that's above me.
Mr. Secretary, does that tell you something about maybe the leverage you think you have, perhaps you don't have, over the Chinese? The fact that they aren't reaching out, they aren't doing those things, despite the fact you've put tariffs up as much as you have?
Well, we'll see. Remember, these tariffs are just going into place. And you know, I think they will have that phone call, and they will have lots of conversation together. I think, for me, the greatest thing for me is that Donald Trump is sitting behind the Resolute desk in the Oval Office, and he is the greatest deal maker, and he will decide how he wants to play his hand. But the way he's played his hand now is, he's been talking about this for 35 years. He wants to reorder trade, to have the world stop exploiting us, to bring the factories back, to bring employment back. You know, no one thought about when NAFTA, which he called yesterday the worst trade deal ever, what NAFTA did, it gave Canada and Mexico sort of the economic right to be a state of the United States without paying federal tax and without respecting the Constitution. But you could build in Mexico and drive to Texas, and build in Canada and just drive across the border. It was all fine, and no economically equal to being Alabama and Georgia.
Yeah.
And so what happened is our manufacturing left America and put those Americans out of jobs. And Donald Trump wants to bring back factories, bring back those jobs, and they can come back. $5 trillion worth of commitments to bring back those jobs is pretty unbelievably impressive. And that's what Donald Trump is capable of.
Also impressive is the sell-off this morning. And a big question the market's asking, how much pain you're willing to tolerate. The S&P's down by 3.7%. The dollar's being sold quite aggressively. Against the euro, we're seeing one of the biggest moves we've seen in the last decade. Mr. Secretary, how much pain are you willing to tolerate? How much market pain are you willing to tolerate?
Donald Trump is focused on the economic pain that the United States of America has suffered over decades. Since NAFTA, 90,000 factories, not jobs, factories, 5 million high-paying jobs gone overseas. He's focused on the U.S. worker and the U.S. economy. And what's going to happen is people are going to realize it is the great American economy that is the winner here. And anyone who doubts it, and anybody who shorts Donald Trump, or anybody who doubts the strength and the power of the American economy, is making a foolish bet. Sure, importers are going to have a tough time figuring out what to do because they went and found the cheapest production in the world. It's time to bring that production home, to have the smart, amazing people who run American companies figure it out, bring robotics back to America. And I would say that United States domestic growth is going to have the greatest resurgence ever under Donald Trump, and that's what he has set in motion yesterday.
You'll accept it takes time to engineer a supply-side response, though, sir. And in the meantime, you can see bad things happen. Do you accept that?
Well, what I can accept, of course, it takes time to build factories, but companies understand how to do it. They will do it. The United States of America is the greatest economy in the world. People have to do business with it. The rest of the world will bring down their trade barriers, and you'll see a great resurgence in our ability to sell agriculture overseas. You'll see factories being built here, and that factory production will be faster. So sure, there will be a rebalancing of those who make things in cheap labor markets, figuring out how to make them here. But ultimately speaking, and I think in much less time than you think, the world will reorder itself, will figure it out, and the United States growth rate will turbocharge compared to the rest of the world. We've been too close to them because we've been, our presidents have been presidents of the world. And Donald Trump ran on the policy that he was going to be the president of the United States, of the workers of the United States, and he was going to place American workers first. And that's what he did yesterday, and that's what everybody's feeling. Those workers have been disrespected, and now they're going to be respected.
Mr. Secretary, just a final question, if we may. Any calls scheduled for today with the Europeans? Do those negotiations start this morning immediately? Can you give us a sense of things?
Absolutely. Our teams are talking to all the great trading partners today, and we are available for our great trading partners every day. It is time for them to do deep soul searching of how they treat us poorly and how to make it right. It is time for them to do that. That is going to be difficult for them because they've taken advantage of us for so long. They should just be disappointed that the free ride is over. It's time for them to be realistic and to change the way they look at the United States of America. And I think that's going to happen starting today.
I think it's changing in real time, sir, in many ways. Mr. Secretary, appreciate your time. The U.S. Commerce Secretary, Lutnick, on the trade tariffs announced overnight from the United States of America. Annmarie, a strong push from President Donald Trump, a strong defense from the Commerce Secretary, and a big round of negotiations coming right up.
And I think we ended it right there. The negotiations start today. He said he's getting on calls with his trading partners. He says, though, the trading partners need to do some, quote, soul searching, Jonathan. So it sounds like this is a kickoff to negotiations, but I didn't get a sense that there is any urgency right now to have those deals and those negotiations wrapped up before April 5th when the 10% tariff takes place, and then April 9th for those reciprocal tariffs that are much higher rates on certain countries.
Lisa, the clock is ticking. It's only a week to go.
Howard Lutnick's response to what happens between now and April 9th, the question you asked him, not a whole lot. it tells you, just to emphasize Anne-Marie's point, it's hard to see the off-ramp here of what exactly could get struck if this is about rejiggering the entire trade system. And there is a key question that seemed to be answered with a bit less urgency than the market feels, which is they're willing to look through quite a bit of Wall Street pain with the idea that ultimately Main Street could benefit.
Which is why this market is down and near session lows. We're down by 3.6% on the S&P 500. Coming up tomorrow, payrolls at 8:30 Eastern Time, and here's your guest lineup. We'll catch up with John Stolfus of Oppenheimer, Priya Misra of JPMorgan, Aditya Bharve of Bank of America, Mohammed Al-Aaron of Queen's College, Cambridge, and the new U.S. Labor Secretary from New York City this morning. Good morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.